Hello everyone, this is Bhavik Chokshi over here and I hope you guys are doing well and your level 1 preparations are going in full swing. So in today's video, we are going to discuss about the all important financial statement analysis, that is FSA of your CFA level 1 syllabus. And needless to say, it is one of the most important areas, around 11 to 14% of your overall weightage, expecting anywhere between 20 to 25 MCQs from this section. So this is very important. Now we are going to cover all the 12 readings which are there in this subject, and we are going to kind of cover all the important areas and aspects, including in certain cases where required even numerical problems, which can help you quickly refresh the concepts before you kind of touch upon your revision, or even before the exams. If you want a quick gist of the subject, this will be something which is very helpful for you. So if you like this video, please do like and put that in the comments as well, means a lot for us. So with that, let's get started. So over here, this is financial statement analysis, and it comprises of around 12 readings from around 27 to around 38, and you will divide this section into 3 parts. So when you go from the first 5 readings from 27 to 31, I would say this is very basic ground level introductory, what is income statement, balance sheet, cash flow, etc. The most important area I would say sits at the center, which is reading number 32 to around 35, which has specific items like inventories, long-lived assets, liabilities, and even taxes. So this is something which we will take the most time, and you should also invest the most when you're revising. And the last section focuses a lot on actually the financial statement analysis, where you try to look at the quality of your reporting, quality of reports. You look at how do you do the analysis, and then how will you use that for the purpose of financial modeling. Okay, so let us get started over here. So we'll kind of do it from both a few written notes as well as kind of the charts. So when you're looking at your FSA, in the beginning you are looking at the first reading, which is Introduction to Financial Statement Analysis. When you're looking at the financial statement analysis, first of all we need to understand what is a financial reporting. When you look at reporting, you're going to just report the statements, your performance in the profit and loss, your position in the balance sheet, and then your cash flow. You're going to report it so that it can help the readers in making the appropriate decision. So when we are looking at financial reporting, this is reporting through the annual reports, etc., where you will give your data which can be analyzed by the people so that they can use it they can do appropriate adjustments and use that data for the purpose of making their necessary economic decisions, like if I'm a bank, should I give you a loan? If I'm a shareholder, should I invest money, etc. Now when I'm looking at financial statement analysis, what is a framework that people are going to use for the purpose of this analysis? First of all, we'll have to clearly define the objective. Like if I'm a bank, I'm doing this analysis to kind of decide whether I want to give you the loan or not. I'll gather all the data for the purpose of my evaluation, process that data. That means I will kind of make certain adjustments if required, analyze it, make calculations like ratios, do comparisons across years, across sectors, and come to the appropriate conclusion, and keep on updating it as a need maybe. Like a lot of credit rating agencies or equity research agencies kind of do that. When they initiate coverage, they kind of gather all the data, process it, and come to a conclusion on whether the stock is worth buying, what is the target price, and hence as events kind of shape up, they kind of even rephrase or kind of modify their assumptions as well. Now when you are looking at this reporting, we have to figure out that what is going to be reported. So in the financial statements, you have the income statement, balance sheet, you have the cash flow statement, and you have the notes to accounts. Along with that, there are a lot of other sources which can also be very helpful when it comes to reporting. Like you have something like the proxy statements, which can be useful for the purpose of US companies, where if a particular major decision has to be taken, then before the shareholders vote, there is kind of a proxy statement which is given, which explains in detail whatever is the requirement. Then you will have, let us say, certain notes as well. This can be footnotes to the financial statements, where there is a lot of information which is given, and there is a lot of material disclosures which are also available for the same. So this is where you will get a lot of material disclosures, like something like segment reporting is also available over here. Then a very important part of your financial statements is management discussion and analysis, where the management gives their perspectives on the risk factors, on what their growth outlook is, and lastly you have the auditor's report. So in the auditor's report, you'll have a lot of kind of opinions, like there is a possibility of a unqualified opinion, that is the account show a true and fair picture, or there can be qualified opinion if there is certain adjustments where the auditor is not comfortable, or there can be a disclaimer of opinion, so the auditor does not have enough data to give the opinion, or an adverse opinion as the case may be. So all of these are there in your basis or units which can be used for financial statements. And apart from these sources which are there in at least US, there's a lot of filings. Like for prospectus, you have the S1, 10K, a very important thing similar to an annual report, 10Q for the quarterly report, 8K like the proxy statement or material report. So there's a ton of data. However, all of the data is prepared using certain accounting framework. Now, these accounting frameworks in the US are under US GAAP, which is under FASB, the Financial Accounting Standards Board sets up the US GAAP, and IFRS, which is used globally in close to 150 odd countries on the planet, which is International Financial Reporting Standards, which is by IASB, the International Accounting Standards Board. So these are the two main bodies which will govern the accounting standards. And throughout this subject, you will see various places where the accounting differs between IFRS and, let us say, US GAAP. Now, when you usually the CFA Institute is very clear in terms of the question of IFRS or US GAAP, but if it remains silent, the general opinion over here is that you should be solving as per IFRS, because that is a generally commonly accepted accounting framework. Okay, regulators over here, let us say there is the SEC, Securities Exchange Commission, or the FCA, for example. All of these, let us say, are now a part of a larger body of regulators, which is the International Organization of Securities, let's say, regulators, IOSCO. The objective of these bodies is to kind of ensure that there is a fairer reporting, they protect the interest of the investors, and in general to reduce the systematic risk which is there in, let us say, in the markets by efficient reporting. Now, in the US, there is also an additional regulation called as the Sarbanes-Oxley Act, which requires a lot of additional compliances if that is there. But again, remember, that is more of a legal thing rather than something that you are going to study over here. There is just loose references which is given in your study text, which is a basic introduction, and I think that should kind of suffice. Now, there are various places where, as you will see throughout, US GAAP and IFRS differ. We have just kind of at the beginning tried to tell you that there are certain cases, at least from what you are going to study, where they differ. Like you have US GAAP, which is largely rule based, set up by FASB, and there's IFRS, which is largely principle based. So IFRS will not give you exact rules. US GAAP will give you those rules. When you look at certain areas, there's a difference, like research and development. In general, under US GAAP, whether it is research or development, will be taken to the P&L account, except for certain software examples. In IFRS, research expense goes to the P&L, development expense is capitalized. So that is a kind of a difference. Under, let us say, the cash flow statement, under the US GAAP, dividend paid is financing, everything else, that is interest paid, interest received, dividend received, everything else is operating. Now, that is kind of a little strange. So IFRS does not really go with that. IFRS says that, well, you know what, if it is dividend or interest paid, for example, if it is interest paid, it can be either operating or it can be financing. Interest received or dividend received can also be either operating or investing, and hence there is kind of a choice over here when it comes to IFRS. More of a principle based thing. There are other places as well, like inventory, if let's say cost or NRV, whichever is lower, and later let's say there can be a subsequent increase in the value. US GAAP says that once you write off, you cannot reverse it. Under IFRS, reversal is possible. These things we'll study at a lot of length along with each of these respective topics, but we are trying to say over here that there are different alternative financial reporting frameworks, and as an analyst, we need to understand the different financial reporting frameworks, because if you are comparing a US company with a, let us say, a British company, they are following different framework, and hence you need to do these adjustments in order to ensure that the statements are comparable and you can make the appropriate analysis. Okay. Other than that, as we discuss, the sources that an analyst gets information are a lot of annual, like the 10K, or even the interim reports at like a 10Q, or let us say an 8K, etc., which can be used for the purpose of analysis. Okay, next you have something called as the income statement. Again, this is a very basic thing. Now, before income statement, there is also some other additional sources which are there. We can just kind of quickly review that, which is, let us say, the sources which you typically use for the purpose of financial statements can come from the issuer, like apart from your 10K, 10Q annual reports, etc. There can also be the earnings call, investor presentations which the issuer shares. Other than that, there can be public third-party research, so you can take industry reports, government reports for a better understanding, or proprietary third-party research you can get you can recruit a particular research agency who does research exclusively for you. So that is proprietary research, or analyst reports or databases, or proprietary primary, that is you can yourself go out and take surveys to understand better. So all of these can be additional sources of information. In the beginning, we are trying to say that we are going to do financial statement analysis, but for that we need information. We are going to gather data. Which are the sources from which we can gather data, and why do I need to make those adjustments, process it? Well, because there can be different accounting frameworks. So that is about the beginning. Next, you go to the next reading, which is, I think, reading number 28, which is on income statements. When I look at income statements, there is revenue. Revenue gets covered, let's say, under IFRS 15, and IFRS 15 has a 5-step revenue recognition framework. That is, you will first identify the contract, then you will identify the promises within the contract, and like, for example, you are agreeing to sell an air conditioner. Along with that, you are giving servicing, warranty. So there are 3 promises: to give the air conditioner, to give the servicing, to give the warranty. So you identify the promises, identify the total transaction price which is going to be paid for all the promises, and then allocate that to each of these 3 promises, and then recognize revenue as and when performance obligations are discharged. So these are the 5-step revenue recognition framework which is followed under IFRS and now also converged along with the US GAAP. Now, when you look at expenses, for example, now the general principle of revenue is you should recognize income as and when it is earned. Like expenses, you should record as and when they are incurred. However, the problem in expenses is there are certain standards which allow you to capitalize certain expenses, or you can take it to the profit and loss account as well. So what, from an analyst perspective, how does it matter? Well, if you charge an expense in the profit and loss immediately, then your current year's profit falls. However, you don't have to amortize or depreciate or write off that expense over the subsequent years, and thereby the subsequent years' profits will be relatively higher. So if I were to expense it, the earlier year's profit would be lower, later years the profit would be higher. Now that will impact certain ratios like a return on equity ratio, for example, where it is based on profit. So if my current year's profit falls significantly because I'm expensing out something, my ROE in the current year will be lower, but in the later years it will be relatively higher. The exact opposite happens if it is capitalization of expenses, where you can decide to kind of show the asset and then write off. So in the current year the expenses are proportionately lower, but in the later years the expenses will still continue, and hence if I decide to capitalize, then in the current year my profits are relatively higher, but later years the profits are lower, and hence the impact on ratios like return on equity, return on capital employed will be exactly opposite. So in the earlier years the ratios will be higher, later years they will be lower. Now you will study later as well, there are certain other ratios like debt to equity or debt to assets. When I look at these items like expenses, etc., they don't impact the debt. However, they impact the equity. Like if I expense out immediately, my retained earnings fall and thereby my equity is lower. So debt remaining constant, if I expense out immediately, my debt to equity will relatively be higher if I decide to expense as compared to if I decide to, let us say, capitalize, where my debt to equity will be lower. So there is kind of a trade-off which kind of managements may utilize / misutilize in order to kind of play around. So that is regarding expenses. Now what we need to be very clear as analysts is non-recurring items. Now these can be items like impairments, reconstructions. Over here, these are usually one-off items, and when you are looking at forecasting, we should avoid taking them for the purpose of our forecasting, because they are not something which is recurring in nature. And when we try to forecast, you should take revenues or expenses which are likely to kind of continue, they're likely to recur. So items like discontinuing operations, etc., you should not be considering. In any case, when you take your profits, those profits should be after excluding these one-off unusual extraordinary items. There can also be changes in accounting policies or estimates, where you kind of see whether these changes are reasonable, and according to you, because of these changes, what is the impact, and if there's an adjustment needed, you will do that as well. So over here, this is your general overview. When you are looking at even the, when the institute gives you a lot of material over here, assuming that you have no background, I believe you have some reasonable background of what is revenue, what is expenses, so you can just skim through this material fairly quickly. The important thing over here is the calculation of earnings per share. So when you look at EPS, earnings per share is the profit attributable to the ordinary shareholders divided by the weighted average number of equity shares. Now that is called as a basic EPS. However, basic EPS considers only the shares which are actually there. However, there's also something called as diluted EPS. So over here, if there are potential equity shares like a convertible bond, like a convertible preference share, or maybe options, in such a case, you calculate what is called as a diluted EPS. And when you calculate diluted EPS, you will do that by assuming, let us say, conversion. So if these convertible preference shares were to be converted, when will they be converted? Let's say at the start of the year or the date of issue, as the case may be, then you will not need to pay any preference dividend. Similarly, if the convertible bonds are converted, you don't need to pay any interest. But if you don't pay interest, you don't even get the tax savings on that. So what you're trying to do is you're trying to find that hypothetically, if there was a conversion, then what will be my profit? So I'll take the net profit minus preference dividend, starting point, plus preference dividend on convertible preference shares, plus interest into 1 minus t if, let's say, there's a convertible bond, and in the denominator, to the weighted average number of equity shares, I'll add the shares on conversion of preference shares, shares on conversion of debentures. Now the only challenge over here can come in terms of options. Now options, you don't have to pay any interest or dividend. However, when options get converted, let's say the holders of the options will pay you money, which is usually not the case in case of conversion of debentures or preferences, where it is just a book entry, that is convertible debentures account debit to equity share capital, for example. However, when options get converted, then the holders will actually pay you money. This money can be used by the company to earn some profits. Now, I don't know how much profits the company can earn, and as a result, there's a treasury stock method which is recommended in order to find the number of shares which are to be adjusted for the purpose of diluted EPS. Like for example, if I were to take, there are 1000 options and the exercise price is 50, the market price today is 80. If these options were converted at the start, then there'll be 1000 new shares that are going to be issued. However, against that 1000, I'll get 1000 into 50, that is equal to 50,000 rupees as consideration, which I don't know what I'm going to do. So the treasury stock method says I will use that to buy back my own equity shares. But if I go in the market to buy back my own equity shares, they will cost me, for example, 80. And as a result, 50,000 divided by, let us say, 80 will come to 625 shares that I will buy back. And hence, all said and done, over here, 1000 shares will be issued. I will get 50,000 rupees. 625 shares will be bought back. I'll pay that 50,000 rupees, and hence 375 shares still remain. These will be the shares, incremental shares, that I will use for the purpose of options. So over here, this is in case of diluted EPS. On the face of the income statement, you need to report both the basic as well as the diluted EPS. Now, when I'm looking at the income statement, there is something called as a common size statement. So in case of a common size statement, what we want to do is we want to kind of look at each number as a percentage of a base to figure out over the years. Let's say if I'm taking 5-year statements, whether the expenses, etc., have changed, and if they've changed, what is the proportion. So if I have the entire income statement, the top line is the revenue, and hence in a common size statement, if you had to prepare, we'll typically prepare the entire statement as a percentage of revenue. So let's say if revenue was 100, then in each of these expenses are how much percentage in this particular year. So this will kind of adjust for size and help us in determining a number on a kind of a common 100 base, which is easier for comparison across years, easier for comparison across companies. So that is your common size statement. Okay. Next, when you're looking at these income statement items, there can be various places where the income statement items can kind of differ. So there is some literature regarding inventories, etc., but we'll do that along with inventories rather than going into everything right now. The initial material over here is just kind of an introductory material when it comes to analyzing the income statements. As you can see over here, in the income statements, there is also what is called as the other comprehensive income. So IFRS as well as US GAAP, along with the income statement, requires you to also give a statement of other comprehensive income, where items like foreign currency, translation gains or losses, or changes in fair values of certain equity or debt instruments can be accumulated over here, or revaluation can be accumulated over here. This is called as other comprehensive income, and your profits plus your other comprehensive income will give you your total comprehensive income. The general principles over here will be the matching principles, where revenue will be recorded and expenses will kind of try to match the revenue. But when you look at period cost will be recorded as and when, like depreciation, for example, you'll be recording it as and when the period kind of passes. There are various methods of depreciation, straight line, declining method, etc. Now, inventory valuation, there's a lot of literature, but again, as I said, we'll keep this literature along to be discussed along with the inventory chapter rather than pushing it right now. These are pertaining to the non-recurring or unusual or infrequent items. We said that we try to study the nature, and most of the times we try to remove the effects of these non-recurring items. Also look at changes in accounting policies, estimates. Then we look at earnings per share. This is something which is very important, basic as well as diluted. You can definitely be asked questions pertaining to that. A lot of ratios which will be helpful, and common size statements automatically calculate a lot of ratios, like the gross profit is there, the GP ratio, net profit is there, net profit ratio, margin ratio, operating profit ratio. So maybe in common size statement, which is a percentage of revenue, this can probably be quite helpful. Okay, so I mean, again, we are just trying to kind of cover everything in the interest of kind of having an exhaustive understanding, though these initial readings are quite manageable if you have done maybe some basic graduation, or even if you're CA intermediate or CMA intermediate, that should be sufficient. Again, when you look at the balance sheet, in terms of balance sheet, there is kind of a lot of disclosures pertaining to the financial position. Income statement is for the performance, balance sheet is for the financial position. You will have property, plants and equipments, intangibles, all of these are called as long-lived assets, for which there's a separate section where we'll discuss. There's also, for example, long-term liabilities, non-current liabilities like lease liabilities, pension liabilities, deferred tax liabilities. Again, for all of this, there is kind of a separate section. So when you look at the financial position, that is a balance sheet, this gives you the position as on a particular date, and there are certain points that are kind of mentioned over here, which are again done at a lot of length, like intangibles. If it is self-generated, you expense it off, whether it is IFRS or US GAAP. But if it is kind of research and development in nature, IFRS has slightly different principles, US GAAP has slightly different principles for research and development. When you look at even assets like financial assets can be shown like investment in shares, investment in bonds, investment in debentures. For example, these under IFRS have three classification. It is either amortized cost, it is fair value through other comprehensive income, or fair value through profit and loss. So these are the three main headings when it comes to IFRS. When you go to US GAAP, in US GAAP you are allowed to show certain investments at historical cost, like if you are unable to determine fair value, like equity shares of a private company can be shown at historical cost. Apart from that, if you are having certain instruments which you intend to hold till maturity, under US GAAP you show them at amortized cost, but the classification is held to maturity. Other than that, if there are certain instruments that you're holding for the purpose of buying and selling, these are under US GAAP called as held for trading. Under IFRS, in a way, it is called as fair value through profit and loss. Under US GAAP, it is held for trading. And there can be other instruments which kind of go into the available for sale category. That is, you don't even intend to hold them till maturity, but you're not even holding them for the purpose of immediate trading. So these are certain, I mean, in terms of assets, these are certain headers when it comes to financial assets between US GAAP as well as IFRS. So that is some basic introduction that they kind of mention over here, that what is about intangible, which is done along with the chapter on long-lived assets. Something regarding research cost is also discussed over here. When you look at goodwill over here, goodwill is something which is recognized if it is on acquisition. It is tested for impairment annually, but it is not amortized, both under IFRS as well as US GAAP. Under financial instruments, as we said, under US GAAP there are three main classifications, and hence, I mean, apart from that, you can also show under US GAAP certain investments at historical cost. Other than that, held to maturity, available for sale, and held for trading. Under IFRS, there are only three classifications: amortized cost, fair value through other comprehensive income, and fair value through profit and loss account. Okay, disclosures regarding non-current liabilities. Again, there is a separate section. Usually for most of the non-current liabilities, you can prepare the liability value, and if the liability value is not the same as its face value, like bonds issued at a discount, etc., then you will need an amortized cost working for showing these liabilities values if the bonds are issued at a discount or premium. If there's a derivative liability, for example, or a trading liability, then you can show these directly at the fair values. Deferred tax liabilities will also be discussed. All of this will be done at a lot of length. Now, when you're looking at common size balance sheets, again, like you have a common size profit and loss, which can help you in your analysis. A common size balance sheet will be a percentage of, let us say, total assets. So over here, you are going to take a lot of these numbers, which are a percentage of, let us say, total assets, and you can kind of compare on a time series as well as cross-sectional. Time series means for the same company across various years. Cross-sectional means across different comparable companies or sectors, and as a result, this will kind of help you in meaningful comparisons. A lot of ratios come out from the balance sheet, like the liquidity ratios, solvency ratios, all of these ratios come up from the numbers from the balance sheet. Okay, next you have analyzing cash flows. Now it is interesting over here that the institute has given two chapters or two readings over here, which is pertaining to the cash flow analysis. In the first reading, they explain you the basics regarding the cash flow. Now, what is an operating cash flow, investing cash flow, financing cash flow? Like when you look at either IFRS or US GAAP, a cash flow statement is to be a core part of your financial statements. And there are three main headings. There is a cash flow from operating activities, where you will show items which are in the day-to-day course of your business, like revenue, cash collection, cash payment, cash collection from debtors, cash payment to suppliers, cash paid for your employees or operating expenses. All of this is your day-to-day operating cash flows. Apart from that, there would be investing cash flows. Now, investing cash flows will be linked to long-lived or non-current assets. When you are buying, let us say, machinery, buying a plant, buying investments, that will go as investing cash flows. And then there is financing cash flows, that is sources of funds. From where are you going to arrange those funds? If not from operations, maybe using loans, maybe using equity money, maybe using debt money. So this is cash flow from financing. So there are three main headings over here. When you look at cash flow from operations, there are two methods. One is a direct method and one is the indirect method. Because it's an MCQ based exam, you're not definitely going to be asked to prepare the entire cash flow statement. However, when you look at the direct method or indirect method, that's a difference only in terms of cash flow from operations. Cash flow from investing as well as cash flow from financing has no such difference. It is going to be the same whether it is direct method or indirect method. So under the direct method, what do? You directly show what are the cash flows. Like you take cash collection from customers minus cash payment to suppliers minus cash payment to employees, etc., and you will get the cash flow under the direct method. This is generally considered to be a preferred method under both IFRS and US GAAP, though most companies in practice actually publish using the indirect method. Why? Because indirect method does not start directly from the cash flows from operations, but it starts from the net profit, and from the net profit it makes certain adjustments. Like first of all, it makes the non-cash adjustments like the depreciation, amortization, impairments. You will kind of reverse that because they're non-cash in nature. Then the non-operating adjustment, like if there is some loss or gain on sale of assets, it is not linked to operations, and hence you will kind of reverse that. And then you will make the working capital adjustments, like if there are operating assets or liabilities like trade receivables, inventories. If there is any particular change over there, well, your profit and loss would have been prepared based on accrual. That is, if there is credit sales, that would have gone into your profit. But if these credit sales are not collected, then that should not impact your cash flow, and hence you will make adjustment for debtors. Increase in current assets, you will deduct. Increase in current liabilities, you will add. Current assets as a direct relationship, current assets as an inverse relationship. Current liabilities are direct relationship. That is, increase in current assets, you will deduct. Decrease in current assets, you will add. Increase in current liabilities, you will add. Decrease in current liabilities, also you will add. So this is pertaining to your indirect method of cash flow. Now, there are certain differences which are there between the US GAAP and IFRS, and that is quite important for you to overall remember. Like first of all, when I look at interest paid, dividend paid, interest received, dividend received, these are four core points. Now, in US GAAP, remember, dividend paid by the entity is the only thing which is taken as cash flow from financing. That's it. Everything else, interest paid, interest received, dividend received, all of this is cash flow from operations. Now, this is a little weird, but US GAAP is weird. So over here, you just need to remember that. And when you look at, for example, IFRS is not as stringent. It gives you a choice. It says, well, it can either be operating, let's say if it is interest or dividend received, it can either be operating, or you can show it as investing because it's linked to investing where you are getting dividend or interest. Or if it is interest paid or dividend paid, well, it can be operating or it can be financing. So over here, if it is paid, then it can be financing. If it is received, it can be investing. This is as per IFRS. Remember, US GAAP has a slightly different treatment. Again, for bank overdraft, IFRS says that if bank overdraft is in a way permanent in nature, it can be financing. Otherwise, if it is a part of your cash management, temporary, it can be cash equivalents. US GAAP on the other hand says overdraft is a borrowing. Whether it is long-term, short-term does not matter. Overdraft is a borrowing, and hence US GAAP says that the overdraft will be shown as a cash flow from financing only. Again, another problem is for taxes paid. US GAAP again makes it very clear. The moment you pay taxes, it is a part of your cash flow from operations. However, IFRS says that generally it can be cash flow from operations if it is linked to an operating activity. However, let us say if there is a capital gain on which you are paying tax, capital gain or the sale proceeds are going to go in investing, so the tax should go in investing. If you have taken interest over income and interest is going in investing, then the tax on that should also go in investing. So over here they are saying that you will take it where the underlying item is kind of going. As we discussed earlier, both IFRS and US GAAP permit both direct and indirect method. However, both of them prefer the direct method. Having said that, there should be a reconciliation that needs to be shown between PAT and cash flow from operations, at least under the US GAAP. Now, this reconciliation virtually makes it kind of compulsory for most people to prepare using indirect method only. They will say, okay, we'll prepare using direct method. Then again, we'll have to show reconciliation. Usse acha, we'll directly prepare using indirect method only. IFRS does not require you to show this reconciliation, but a lot of shareholders demand this reconciliation for understanding the difference. And hence, most companies, if you actually see in practice, end up publishing using the indirect method only. Okay, so we have explained, as we said, indirect method, there will be three adjustments. One is the non-cash, one is the non-operating, and then there's a change in working capital adjustment through which you will find the cash flow from operations. Cash flow from investing and financing kind of remains the same. Now, when you look at trying to find the quality of your financial statements, cash flow is something which you cannot manipulate. See, remember, profit, you can use accrual concepts. You can always say that, okay, I will make provisions, I will delay revenue recognition or accelerate revenue recognition, but you can't really pay with the actual cash. If it is received, it is received. If it is not received, it is not received. And hence, this kind of shows a very good position. Like when you look at PAT, profit after tax is calculated after a lot of expenses, like for example depreciation, which are non-cash in nature. So inherently PAT is biased downwards as compared to cash flow from operations, because cash flow does not include the non-cash expenses. It does not include impairments, it does not include write-offs, it does not include depreciation. So typically for most of the companies, we can say that if the company does not have, in your Gen Z language, red flag, we will say that the cash flow from operations should ideally be greater than the PAT. Because PAT has a lot of non-cash expenses. Even if we skim out, remove all the non-cash expenses, your cash flow from operations should relatively be higher. So this is a normal company. However, in certain cases, you might see that your cash flow from operations is lower than the PAT. Now, this is what you call as a red flag. In most of the cases, you'll say, how is that possible? With all the non-cash expenses, your cash flow from operation is even lower. It may be because you might have accelerated revenue recognition. You might have said that, okay, I've sold a product for 3 years, which has let me recognize everything as revenue right now. Customer is going to pay me money over 3 years. However, I have recognized the full revenue. Now, what has happened is, because revenue is recognized, profit is higher. However, money has not come in. And as a result, over here, your cash flow is relatively lower. Same is the case with, let us say, certain debts, or you might end up booking fictitious sales. You might say that, okay, current year I'm doing an IPO, let me book some fictitious sales. Later, I will show a bad debt. So when you book those big sales, right now it is debtor account debit to sales. So all of this will jump up your sales and thereby your profits. However, because they are fictitious, they will not translate into actual cash, and thereby your cash flow from operations will be lower. So over here, that is quite of a interesting thing. Again, we have tried to prepare a sample kind of cash flow statement. Let us say if it is a startup, usually it will burn money. I mean, its expenses are greater than income, so cash flow from operation is negative. It is investing a lot in new assets, marketing, etc. So cash flow from investing, etc. is also negative, and that is why it needs a lot of funding. You see, startups need a lot of funding largely because their CFO is negative, their CFI is also negative. However, when you look at a steady state company, let us say someone like a Reliance, then I will generate a positive cash flow from operations. However, in general, I will need money from this operation to grow my business, and hence I will have a negative cash flow from investing so that I can invest. Financing can be positive, negative, it kind of depends. Certain years when you're taking the loan, it is positive. When you're repaying the loan, it can be negative. Okay, so if CFO is less than PAT consistently, then there can be some accounting or accrual manipulation that you can be possibly doing, which will require a deeper introspection, which is necessary. Okay, now when you look at cash flow, we prefer cash flow from operations to be positive, because this will be profit plus non-cash expenses plus non-operating expenses plus or minus working capital changes, that is your CFO, and we prefer it to be positive. Now, higher the CFO, typically higher should be the profit. This is sustainable. But higher the CFO, how can you generate a higher CFO? Now, there are three components in CFO. First is by profit. Acha, these are just adjustments. And then there is some working capital change. So if your increase in CFO is actually driven by higher profit increases and CFO increases, that is sustainable. However, what you are doing is you are currently liquidating your stock. You are saying that my opening inventory was 100, let me sell all the opening inventory, let us have zero inventory, that was at the closing. So over here, you have not manufactured a lot of goods in the current year, but you have sold whatever was there in the opening stock. Now you are liquidating your current assets, you are liquidating your working capital. That might temporarily show a higher cash flow from operations, but that is not sustainable. So we will say that a CFO which is higher, which is primarily driven by a reducing working capital. So we said that working capital comprises, let's say, of current assets, and if current assets are reducing, that means you are going to add, because if debtors are reducing, that means you are collecting money. If inventory is reducing, that means you are again having a higher money. Inventory is reducing, you are probably manufacturing less. In which case, over here, if CFO is increasing because of higher profit, it is sustainable. But if it is increasing because the working capital is getting liquidated, it is not something which is a sustainable event. Now, when you look at even analysis in cash flow, which is people don't do it as much when they kind of do it in balance sheet or income statement. When you look at analysis for cash flow, again over here something like a common size statement can be helpful, but here the common size statement will be a percentage of your total cash flows. If it is a percentage of cash inflows, you can take total cash inflows, and a percentage of that if there's an inflow. If it is a total cash outflow, then it's a percentage of total cash inflow. So in a common size statement, BNL is a percentage of revenue, balance sheet is a percentage of total asset, but in cash flow, it's either a percentage of revenue or it can be a percentage of cash flow. If it's a percentage of cash flow and it's a cash inflow item, then I will take it as a percentage of total cash inflow. Cash outflow item, I will take it as a percentage of total cash outflow. Though people don't do as much common size evaluation for cash flow statement as much as they do for the balance sheet or the profit and loss account. Okay, now as we proceed further, we are discussing both the cash flow chapters together. There's something called as free cash flow. Now free cash flow is discussed at a lot of length in, let us say, your level 2, and also to some extent a brief discussion maybe in your equity section. But what is free cash flow? This is the cash flow which is freely available to the providers of capital. Who is the provider of capital? Well, if it is the enterprise, then debt and equity both are providers of capital. If it is just, let us say, from owner's perspective, then it is the equity. So there are two measures of free cash flow. One is the free cash flow to the firm, FCFF, and second is the free cash flow to equity, that is FCFE. Now when you look at the free cash flow to the firm, this is the pool of money which should be available to pay the debt and equity both. Sir, is PAT, profit after tax, that pool of money? The answer is no. PAT is available only for equity, and more so, PAT is not a cash flow. So what you will do is you will first add back the non-cash expenses, so PAT plus depreciation, so that will become a cash flow. But again, this is not available for debt and equity both. It is available only for equity, and hence you will add back interest. However, if interest is financing, the tax savings that you get on interest should also be reversed, and hence interest into 1 minus C. So this will typically give you your CFO, the cash flow from operations. This will typically give you that, at least under IFRS. Okay, I mean US GAAP interest maybe over here taken as operating, etc. But let us say over here you are taking PAT plus depreciation. However, in CFO you should also have working capital adjustments. Yes, because I mean, I am saying free cash flow means that money should be freely available to distribute as dividend. Whether I distribute or not is my prerogative. However, it is not necessarily the entire CFO I should distribute. Why? Because I may need to keep aside some money for my capex requirements, some money maybe for my working capital requirements, and hence I will deduct my increase in fixed asset, which is called as capex, deduct my increase in working capital, and thereby the money that I can then say is left over will be taken as my cash flow from free cash flow to the firm. Okay, again we'll prefer a higher free cash flow to the firm. When you look at free cash flow to equity, equity gets money after debt is paid off, and as a result you would start with PAT, add back depreciation, don't add back interest into 1 minus T, because debt holders will get money and only after that will equity get. Again, you have to keep aside money for the working capital commitments, you have to keep aside money for fixed capital commitments, but as an equity holder, you also have to keep aside money to pay the borrowings, net borrowings, taken repaid, that is also to be adjusted in your FCFE. So over here, plus or minus net borrowings as well. Now over here under US GAAP, if I go to see CFO, the cash flow from operations is after interest. So you will add back interest into 1 minus T minus increase in fixed assets. Again FCFE, CFO, it is after interest. It should be after interest, and hence you don't make any adjustment, minus fixed assets, but plus or minus the net borrowing, because the principal component of loan has not been considered. So this is slightly tricky. Having said that, free cash flow as a concept is tested a lot more in your level 2 as compared to your level 1. Okay, when I look at I mean the next that goes into inventory, but if I kind of just quickly skim through these readings, if we have kind of missed something over here, we are saying cash flow statement, then you have under the direct method cash payment to customers, operating expenses, etc. CFI and CFF. CFI is due to asset accounts, CFF is due to providers of capital, that is fine. There are certain calculations, conversion, I mean there can be certain adjustments where you may need to kind of convert from direct method to indirect method. Now, if for example direct method you have a cash collection, or let us say you have just the sales. Now, adjusting the debtor account to the sales will give you, let us say, the cash collection, or the other way around. So maybe sales, if I take opening debtors plus the sales minus the closing debtors, I'll get the cash collection. So I can use that equation and try to find the numbers if it is required to convert from direct to indirect or vice versa. Now, these differences between IFRS and US GAAP regarding dividends, interest, we have discussed already. Then in the other part, you're trying to kind of look at the free cash flow to the firm and free cash flow to the equity workings. There are certain ratios, cash flow ratios, to be honest, not as important as the subsequent income statement or balance sheet ratios, but these ratios are in a way self-explanatory. Cash flow to revenue, CFO divided by revenue. Cash flow to assets, CFO divided by average assets. Return on equity, CFO by average equity. CFO to income, CFO by operating income. CFO per share is CFO minus preference dividend upon number of shares. So this kind of self-explanatory ratios. Debt coverage will be CFO by total debt. Interest coverage will be CFO plus interest plus taxes by interest paid. Reinvestment ratio is slightly different. CFO divided by cash paid for long-term assets. So that will be your reinvestment ratio. Debt payment will be CFO upon cash paid for long-term debt payment, like in your financing cash flow. Dividend payment, CFO by dividend paid. Investing and financing, CFO by cash flow from investing and financing. So largely these ratios are self-explanatory. Having said that, they're not as important from an exam perspective. So the next section that we do now, so your first section of FSA is kind of done, where you are having the introduction. The next section from the next 4 readings, that is analysis for inventory, then long-lived assets, then liabilities, and taxes. In my opinion, this is the most important section from your level 1 perspective. So let us jump on into inventory. Now, when you look at inventory, there is some difference between IFRS and under US GAAP. So let us first get on into that. So when I look at inventory, inventory is something that you are holding for the purpose of sale or for the purpose of consumption in the ordinary course of business. It can be raw materials, work in progress, finished goods, stock in trade, etc. All of this can be inventory items. Now, inventory is initially recognized at cost. However, at every subsequent balance sheet, you will compare, at least for IFRS, the cost with something called as the net realizable value. Net realizable value is the estimated selling price minus estimated selling expenses minus estimated cost to complete, and you'll select whichever is lower. So if your cost is $100 and your net realizable value is 80, 100 or 80, whichever is lower, and hence you'll show it as 80, and 20 will be shown as a write-off in your profit and loss account. So this is using IFRS. Now this inventory also can be measured using various methods. So initially you will recognize it cost, but how does inventory move? Like you are buying, selling, buying, selling, buying, selling. So there are certain cost flow assumptions. What do you mean by cost flow assumptions? You will make an assumption. Like it is very difficult to specifically identify which inventory you have bought and exactly which inventory you have sold. So if you can do that, like for antiques or for relatively rare items like paintings, etc., you can very well do that. In which case you can follow something called as a specific identification method. You exactly find which inventory you have purchased and which inventory was sold, and you try to find you try to match it. However, for most places it is virtually impossible to keep a track that, I mean, which the inventory that is getting sold is out of which inventory. I might have bought inventory from so many distributors, so many suppliers at so many different points of time. A customer comes and picks up one of these products. Now, I don't exactly know when it was purchased, from which supplier it was purchased, which cost was purchased. If I want to do specific identification, I need to find that. However, most of the standards don't require you to go into that much of detail. They say that it is absolutely fine if you were to, instead of taking specific identification, you can take a cost flow assumption, which under IFRS can be FIFO, first in first out, or it can be weighted average. That's it. IFRS allows only 2 methods, but when you look at US GAAP, apart from these 2 methods, there's also LIFO, which is permitted. So when I look at IFRS, inventory can be measured using FIFO or weighted average. You measure it at cost or NRV, whichever is lower. And NRV definition, we have said as estimated selling price minus estimated expenses to complete the sale or complete the production. Now, let us say under IFRS, if your inventory has gone down from 100 to 80, you book a $20 write-off. In the next year, let's say market situation increases, your inventory value goes up. Again, that same inventory is unsold, it goes up from 80 to, let us say, 90. Can you reverse it? Yes. You can reverse 10 rupees because it has gone up to 90. It goes up to 100. Can you reverse it? Yes, you can go from 80 to 100. But it goes up to 105. You can't reverse up to 105. You can go up to 100. You can't take it above cost. but reversal is permitted, which is quite logical. Reversal of write-off is up to cost is permitted. So these are the three things under IFRS, and if you have done, let us say, an Indian accounting standard study, these are the same principles which are there even under the Indian accounting, so there's nothing new. So sir, what should we focus? We should be focusing on the US GAAP, and that is something which is important. So under US GAAP, inventory can be measured using either cost, it can be measured at cost, and then later using either FIFO, which is fine, weighted average, which is fine, but also LIFO. LIFO is permitted under the US GAAP. Now, for inventories which are measured either using LIFO or maybe the retail method, they can be measured at the balance sheet date at cost or market. Remember, usually US GAAP also says that you can measure it at cost or NRV, whichever is lower, but this is for FIFO and weighted average. This is exactly the same. Now, IFRS also has this, US GAAP also has this. FIFO weighted average, IFRS, US GAAP, there is no difference for measurement and even on balance sheet. However, if it is LIFO, which is unique to US GAAP only, then at the balance sheet date you will measure it at cost or what they say is market. Now the problem is, what do you mean by the word market? Market is said to be replacement cost. Now there's a slight difference between NRV and replacement cost. Net realizable value is the value that you will get if you were to sell the product. Replacement cost is if I were to replace, that is buy the product from somewhere else, at what price can I buy the product? That is called as the replacement cost. So when I'm looking at LIFO, they say that the valuation should be at cost or market, whichever is lower. Now what is market? Market is typically replacement cost. But when they take replacement cost, they have given you kind of an upper and lower boundary that what can be replacement cost. They have said replacement cost has to be between the NRV at the upper end and the NRV minus, let us say, a reasonable profit margin at the lower end. Now this is a little difficult to understand, and hence we'll try to apply this with a numerical so that it is clear for you. So for LIFO or for retail method, it is cost or market, whichever is lower. Now what is market over here? So if I were to, let us say, take an example, let us say there is an inventory whose cost is 210, its estimated selling price is 225, estimated selling expenses is 22. So what is the NRV? Well, 225 minus 22, that is equal to 203, is going to be the NRV. Now if FIFO or weighted average is followed under US GAAP, or either of these is followed under IFRS, the measurement will be cost, that is 210, or NRV, that is 203, whichever is lower, that is 203, and hence there will be a $7 write-off. 210 or 203, whichever is lower, so there's a $7 write-off, and that's about it. However, when you go to US GAAP, and let us assume you are following LIFO, then how will the workings change? Well, there will be a few other data points which are given. Let's say the replacement cost is given to you as 197, okay, and the normal profit margin is given to you as 12. So when I try to establish a boundary, this replacement cost has to be within the boundary of NRV, that is 203, to NRV minus 12. So that, let's say 191. This is NRV, which is the selling price. If you remove the profit margin from this, it will come to around 191. So is 197 between this? Yes. And as a result, this can be taken as market. So over here, your market is 197. So you will compare your ledger balance, that is, let us say 210, with market, let us say, which is 197, and select whichever is lower, that is 197, and hence there will be a $13 write-off over here. So this is a good numerical which can help you understanding the US GAAP nuance over here. Achha, now there is one more difference between US GAAP and IFRS. US GAAP says that once inventory is kind of written off, you cannot reverse the write-off, which means, let us say, in the later year, if this inventory remains unsold and you are, let us say, under the IFRS regime, and the inventory remains unsold and the value of the inventory goes up from 203 again back to, let's say, 210, 220, whatever it is, then the 7 that you have written off can very well be reversed. This reversal can be permitted under IFRS. But when you go to US GAAP, let the market base of your inventory go up. It does not really matter. There will be no reversal. You will still continue to show the inventory at 197 only. So over here, this is a very interesting thing if you want to understand regarding LIFO. And also another difference, that there will be no reversal of write-off permitted under the US GAAP. So long story short, if I were to look at the differences between US GAAP and IFRS for inventory, no difference if it is FIFO or weighted average, but if it is LIFO, which is an additional method permitted under the US GAAP, then you can measure the inventory at the lower of cost or market. Market over here is kind of the replacement cost, but the replacement cost has to be between the NRV and NRV minus, let's say, a reasonable profit margin, in which case you can kind of do a write-off. Again, in US GAAP, an important thing is whether you are FIFO, weighted average, or LIFO, once your inventory is written off, you cannot be reversing it. Under let's say for natural resources like agricultural commodities, or let us say mineral resources, both US GAAP and IFRS give a special guidance where they permit you to show these items at your NRV, agri commodities or mineral resources. This is a special case which is there for both US GAAP and IFRS. Now, one point which is important over here is, as we said, this LIFO and these adjustments. Now, when I look at, so we have even given kind of a summary: inventory valuation under US GAAP, FIFO weighted average is cost or NRV. For LIFO retail price, it is cost or market. Market over here is replacement cost, where it is between NRV and NRV minus normal profit margin. So that is a summary that we have. Now, majority of the times and this is something which is very important, you have to kind of go a little slow when you are revising over here. Just a second, please. This is what pertains to the impact of inflation on your particular profits, COGS, closing inventory, and thereby a ripple effect into your ratios. So be very calm and do this properly, because this has the highest probability of coming, let us say, in your exam. Now, most of the countries are in inflationary environments. Now, there are certain countries like Japan which may be under deflationary environment, but most countries are under inflationary environment. So under, let us say, an inflationary environment, what might happen is the prices of the products are increasing. So if you are following a method like FIFO, then the products that you bought earliest are assumed to be sold earliest. So first in, first out, which means your cost of sales will be made up of the oldest products. Now, oldest products are the cheapest products, so your cost of sales will be lowest under FIFO in an inflationary environment. And if your cost of sales are lower, that means selling price remaining constant, your profit is higher under FIFO. But if profit is higher, tax says that I'll follow the method of accounting used in the books, in which case your tax will also be higher under FIFO if, let us say, I were to look at an inflationary environment. However, when I look at LIFO, what does LIFO say? LIFO says that the oldest inventory, last in, first out, the oldest inventory will be stuck into your stock. Last in, first out. So the most recent one that you have bought will be sold first. Now, LIFO is usually not used as much. However, there can be certain business where LIFO is appropriate, but let us say whatever it is, when I look at LIFO, your latest products will be the most expensive products because of the inflationary environment, and hence if the latest products are the most expensive ones, in which case your LIFO COGS, cost of goods sold or cost of sales, will be the highest, because the latest goods that you have bought are the goods that you are assuming are going to be sold first, and hence your cost of sales are the highest, thereby your profit becomes the lowest, and thereby your tax is lowest. So when I look at the extremes over here, this will be for FIFO and LIFO. Weighted average almost sits in the middle of the two. So this is regarding cost of sales, this is regarding profits, this is regarding tax. But what about closing inventory? Well, when I look at the closing stock, FIFO, the closing stock is comprising of the latest units, because first in, first out, the oldest units have been sold. So what is unsold is the recent units, and hence the recent units are the most expensive. So your closing inventory under FIFO will be the highest, but your closing inventory under LIFO will be the lowest, because LIFO has assumed that the oldest stocks are still unsold, and the oldest stocks in an inflationary environment are the cheapest ones, in which case your closing inventory will be lower under LIFO, will be highest under FIFO, and weighted average will be somewhere in the middle. So when I look at, let us say, FIFO, LIFO and weighted average, let us say under, okay, this is only particularly for US GAAP, because LIFO is only allowed under US GAAP, it is not allowed under IFRS. So if I look at inflation that is rising prices, FIFO will result in the lowest, I would say, COGS, because the older units, as we explained, are going to be sold first. Thereby this will result in the highest profits, lowest COGS, highest profits, and thereby end up with higher taxes. LIFO, on the other hand, will have the higher COGS because the recent units are sold, thereby resulting in lower profits and thereby resulting in lower taxes. However, when I look at the inventory position, because the most recent items are in the FIFO inventory, then that closing stock will be higher. The oldest units are in LIFO inventory, so where closing stock will be kind of lower. Weighted average, you remember, is going to be somewhere in the middle. Now, apart from that, there are certain ratios. So if I look at the ratios pertaining to profitability, like the net profit margin, now because the FIFO net profit is higher, then the NP margin under FIFO will be higher as compared to that under LIFO. Second, you look at the current ratio. Achha, current ratio takes current assets by current liabilities. Under current assets, you will have stock. So when I look at stock, FIFO's stock, first in, first out, your FIFO stock is the higher stock because it is made up of recent purchases and hence your current assets are higher. Thereby, your current ratio over here is also higher. Okay, LIFO is lower. When you look at activity ratios like turnover ratios are COGS divided by inventory. Now, this kind of is a little bit of confusing because under FIFO, you will find that your COGS is relatively lower, but your closing stock is relatively higher. So there are two things in the ratio. You will have a lower numerator and a greater denominator pushing down the ratio. So this is, I mean, you'll have to think through it, but if you kind of mathematically see this, we're just doing a revision right now. Your COGS will be lower under FIFO, so your numerator is lower, your inventory will be higher, and as a result, over here, your overall ratio is going to fall. Okay, days outstanding, this is the inverse. If you, I mean, we'll do the ratios at the end, but if you remember, it is the inverse into 365 days. If you take the inverse, it is going to be opposite. So if the turnover ratio is a lower, your outstanding days will that ways be higher. So then there is solvency ratio. So solvency ratio is debt divided by equity. Now, if I look at debt, your debt is not going to change whether you follow FIFO or weighted average, but equity is. Now, when you look at FIFO will result in a higher profit. As we saw, it is lower cost of sales, and thereby FIFO will result in a higher profit. If it is higher profit, that means your equity is higher. Debt remaining constant, it has a higher, slightly higher equity, but because of that, the ratio is lower. Now, there's a lot to think over there. That is why I'm saying that this is something that you have to do very calmly. This section, we have discussed all what is higher, lower, but you can't just remember this. You have to understand this and apply to. Once that goes into a flow, it is very, very easily manageable, but it requires some bit of deeper thoughts. So over here, when you look at decreasing prices, the effect is exactly the opposite. So there is certain points which are given for decreasing prices as well. Now there's a concept of something called as LIFO liquidation. Now what do you mean by LIFO liquidation? LIFO liquidation means that, let us say you have a lot, you are following LIFO method, and you have a lot of opening stock. Now what happens is, in the current year, you utilize that stock, you liquidate that stock. So that ways your selling price for those units is what the customer is paying, but your cost comprises largely of the older cost because this inventory is now liquidated. Usually, if your opening stock and closing stock remains the same, so if opening stock also is 1000 units, closing stock is also 1000 units, and you are following LIFO, that means that LIFO stock of opening will remain in LIFO stock of closing, and hence when you calculate profits, sales minus current year purchases would effectively come. However, if you liquidate the LIFO stock, which means your closing stock falls down, but when you calculate your cost of sales, that cost of sales will be made up of the cost items which are from the current year, but also cost items which are from your opening stock, and these are cheaper items, and hence you might end up temporarily showing a higher profit. Sir, it is difficult to understand. Yes, we'll try to look at this with a numerical. So let us say LIFO liquidation, there's decline in inventory in periods of rising prices. You might do that. For example, your opening stock was LIFO oldest, so this is 1000 units at rupees 10, so this was 10,000 in your opening stock. Now during the current year, you have purchased 500 units at 15 because they are rising prices. Your current year purchases are expensive. Now what you ended up doing is, your closing stock is just 100 units, which means you had 1000 in the opening, 500 purchased during the year. Out of 1500, only 100 is in closing stock, which means you have sold 1400. You have sold 1400. Okay, I'm following LIFO, that means last in first out. So this 500 units are purchased in the current year are sold. So 500 into 15 will be a part of your cost. However, apart from that, your opening stock you have liquidated. Out of the 1000, you might have sold 900. So 900 into 10. So that's a very low number. So 900 into 10 plus 500 into 15, that is your cost coming to only 16,500. In the normal course, had you maintained your inventory, that means, okay, if I wanted to sell 1400 units and if I want to maintain my inventory, okay, then if my opening stock is 1000, my closing stock also has to be 1000, in which case I have to purchase not just 500 units, I have to purchase 1400 units in the current year. And if I'm following LIFO, my closing stock is still going to be made up of my oldest units. So in such a case, 1400 into 15, if I go to see, boom, you get a 21,000 cost. And thereby, if I look at this under my COGS, if I were to liquidate my LIFO inventory, is merely 16,500. Otherwise, if I keep my inventory constant, it's 21,000. And hence, I can actually temporarily gain my profit, increase my profit due to LIFO liquidation. And hence, this is sometimes used to kind of see that is this increase in profit in the current year due to, let us say, you ending up liquidating your LIFO stock. So this is called as the effect of LIFO liquidation. Now, apart from this, there are a few other things in inventory as well, especially when you look at the trend in terms of the ratios, etc. All of these things we have discussed in terms of the impact on profitability, ratios, cost of sales, gross profit. What I want you to discuss over here is, well, there will be a lot of disclosures which will be given in terms of inventories. So you'll have to kind of study those disclosures on terms of whether this inventory has been pledged, what are the reversals if any under US GAAP, is this inventory comprising of agricultural or mineral products, what are the nature of finished goods, raw materials, etc., which is there in your inventory. So all of this you will kind of study, but what I want you to look at this is this last section over here, which is important from an analytical standpoint. So what will happen is, over here, an analyst should examine inventory disclosures to kind of figure out a few things, like if inventory turnover is too low. What is inventory turnover? COGS divided by inventory. Now that turnover is too low, that can showcase that there is very slow or obsolete stock. You are making inventory but it is not getting sold, it is showing slow or obsolete inventory. Other than that, if there's high inventory turnover, people might say it is very good. That means the inventory is not obsolete. However, if the inventory turnover is very high, it might show that you don't have enough stock. Maybe you are losing sales because you are having lesser stock. So this might show inadequate inventory and thereby some lost sales because orders could not be fulfilled because the turnover ratio is so high that maybe there are customers who are coming with big orders, you have to shoo them away because you don't have as much stock. The best position for a company is a high inventory turnover together with high sales. So earlier we said there is a high inventory turnover together with low sales. So we're saying that turnover ratio is very high, but sales growth is very low. It may be because you're not able to grow the sales because your stock is less. But if your inventory turnover is high and the sales are growing, that is the most ideal situation where you would say that this showcases efficiency rather than inadequate inventory because the sales are growing. You cannot say that you're shooing away the customers because you have no stock. In this case, a high inventory turnover backed by higher sales growth showcases, let us say, a healthy inventory policy. You have enough inventory and that is helping you grow as well. Okay. A similar working should also be seen for analyzing the raw materials and the finished goods. Like for example, if in the first case finished goods inventory is growing but raw materials are declining, what does this showcase? You are kind of building up production. Your raw materials are lower now, but finished goods are increasing. Maybe that is because customers are not buying your finished goods. So this showcases decreasing demand, and can kind of you can expect a future inventory write-off. Further, another possibility over here is your raw materials are increasing. So maybe the company is expecting a big demand for the products. That is why they're stocking up raw materials so that they can make more finished goods. This can kind of point out to an analyst a possible increase in demand. And lastly, if let us say finished goods are increasing, but they are increasing greater than sales. So ideally your growth in finished goods can be mapped up to growth in sales. But if your sales is growing by just 10%, finished goods are growing by 40%, probably it might showcase a build up of inventory. You thought sales will grow, it did not grow, and hence it kind of built up onto your inventory. It might showcase decreasing demand and obsolescence on an inventory, which can possibly result in a future inventory write-off. So this is very, very important from an inventory perspective. Definitely, I can almost certainly vouch for the fact that you will get a question at least on your inventory section in your MCQs. Next, you go into long-term assets. So most of the discussion in terms of the long-term assets over here is around your intangibles and then to some extent regarding impairment. So first of all, when I look at intangibles, when you look at intangibles, an intangible can be identified, that is something which is separable and which can be sold separately. Like for example, a patent can be separated out and sold separately, or it is a license. which gives you contractual right or a license over here as a case maybe, they can be identified. However, certain intangibles can be unidentified, like you cannot separate and sell them separately, like something like market share or maybe skilled workforce, and hence these are unidentified assets. You cannot record them separately. However, if you were to purchase it as a part of business combination, then it may come along with goodwill. So at most places, when you look at internally generated intangible assets, generally they're expensed. Why? Because the cost may not be reliably measured and hence they may be expensed. However, if they're purchased, then it is fairly easy to determine cost, and as a result, you can recognize the intangibles which have been purchased. If intangibles are required as a part of business combination and you can identify them, then you will take them over at fair value. If it is unidentified, then typically they are subsumed or included within the larger goodwill number. Now over here, the important thing is understanding what is happening in the research and development side. When you look at IFRS, it is very clear. IFRS says research expense will be taken to P&L. What does research phase means? It means ideation phase. You are still having an idea. You don't know whether it is going to translate into a commercial reality or not. So future economic benefits are not certain, and hence expenses incurred during the research phase will be taken to the profit and loss account. However, if there are expenses which are during the development phase, if there are certain conditions which are met, like it is technically feasible, financially viable, legally permissible, cost is measurable, in which case expenses during the development phase are permitted to be capitalized under IFRS. On the other hand, when you look at the US GAAP says in general research cost as well as development cost has to be taken to the profit and loss account. They just give one exception over here, that is software which is developed. So R&D, both of them will take into the P&L account. If I'm a pharma company, etc., I will take them into the profit and loss account. However, if I'm a software company, then they say that if I am a software company and I'm making software either for the purpose of sale or for the purpose of my own use, like Microsoft can make software for the purpose of licensing it or selling it to others, or there can be companies who are making their own internal software for their own internal processes. Irrespective, these processes can help them in reducing costs as well. So software can be shown over here. But even if it is software, now US is considered to be kind of the hub of software innovation, and as a result, they've given a separate guidance, particularly for software, where they say that any expenses even in the research phase for software will go to the P&L account. So it does not matter software is for own use or for sale, it will go in the P&L account. However, development phase, that is after ideation till the time the software is ready for use, if there's any expenditure incurred, and if you are going to sell the software, if there is feasibility, if you think that the software is feasible, then from the point of feasibility, expenses can be capitalized. However, if you are going to use the software internally, you are not going to sell it, then after it is probable that the firm can complete the software. A lot of times what happens is you take the software project but you don't really complete it. So they say that once it is probable that the project will be completed, you can capitalize. So it's a completely different guidance over here. If I were to summarize, it is for US GAAP. In general, research and development has to go to the profit and loss account. However, if it is pertaining to software, then there's a special guidance. Whether it is for own use or for the purpose of sale, research cost even for software will go to the profit and loss account. But the development cost can be capitalized. If it is software for own use, then till the time it is probable, once it is probable that the software will be completed, then the cost can be capitalized if it is for own use. And if it is for sale, once it is probable or you believe it is feasible for us to make the software and sell it, then you can kind of capitalize it. So this is a special guidance when it comes to research and development. Under IFRS, an intangible can follow cost model or revaluation model. Again, revaluation model can be done in rare cases where fair value comes from an active market, but revaluation model is permitted. When it comes to US GAAP, for intangibles, you can follow the cost model and cost model only. So that is a lot more restrictive. When you look at US GAAP, when it comes to intangibles, it's a lot more restrictive. Now, then you go to impairment. Now, impairment over here, when you look at IFRS, there is IFRS or IAS 36, which says that you will compare the carrying value, that is your ledger balance, with something called as recoverable value. Recoverable value is the higher of fair value less cost to sell, or the value in use. Value in use is calculated as the present value of future cash flows, and that's about it. Usually, IFRS says that you will do impairment testing, that is, you will calculate recoverable value only if there are indicators. If I believe that there are indicators that there is a possibility that there is impairment, only then will I do the recoverable value testing, in which case I'll compare the carrying value with the recoverable value, which is a higher of fair value less cost to sell, or value in use. So if your carrying value is 100, let's say if your net selling price is 75, value in use is 90, higher of the two is the recoverable value, and hence 100 minus 90, that is 10 rupees is my impairment, which will go into profit and loss account typically. However, when it goes to US GAAP is again a slightly different thing in impairment. They say that if I have to impair, first of all, I have to first show that the asset may not recover the carrying value through future use. No, but how will I show that? Well, they have two tests. One, there is something called as recoverability test, which means they will compare the carrying value with the expected future cash inflows. Mind you, not the present value of future cash inflows. Value in use is the present value of future cash inflows. US GAAP says, I will first do a top level check on whether, forget discounting and time value, whether this asset can recover cash flows. If it can, then I will ignore time value and I will not go further into the second step. So I will look at the recoverability test. Recoverability test will say I will compare the carrying value, let's say 1000, with the total undiscounted cash flows, let's say 950. Now I can say, even if I don't use discounting factor, even if I don't do present value, the asset is not recovering full 1000, in which case I will go to the second step. Second step is the impairment testing, where they will compare the carrying value, let us say 1000, with something called as a market. Again, they don't look at recoverable value, they look at market, or they call it directly as fair value. So they will not do the entire recoverable value testing where they take the present value of future cash flows. They will not even do fair value less cost to sell. They will directly do carrying value minus a fair value. That is about it. Now this is over here again similar to inventory. Impairment reversal can be permitted subject to certain conditions. In case of IFRS, US GAAP, inventory also they don't permit reversal write-off of the write-off. Even for long-lived assets they don't permit. Now for US GAAP especially, we would want to understand it with the numerical, so we'll try to kind of take a number. Let's say there's an asset with an original cost of 100, accumulated depreciation is original cost of 900, accumulated depreciation is 100, which means carrying value is 900. This is the amount which is appearing in the balance sheet. Okay, now I'll have to compare, let us say expected future. I'm focusing more on the US GAAP part. IFRS, I believe you will be able to manage, but nevertheless, if you want, we'll discuss that as well. So if I look at expected future cash inflows, let's say this is 795. So I will compare under US GAAP your 800 carrying value with 795 undiscounted, and my recoverability test says that I cannot recover, in which case I will go to the second step. Acha, my fair value is 790. Now my value in use is 785. My cost to sell is 30. Now, if I were to look at IFRS, in IFRS there's nothing called as recoverability test, which means if you want to test for impairment, you will compare the carrying value, for example, that is 100, with the recoverable value. Recoverable value is fair value less cost to sell, which is 790 minus 30, which comes to 760, or value in use, which is 785, whichever is higher, that is 785, and hence $15, that is 800 minus 785 will be the impairment under IFRS. But when you go to US GAAP, you will first look at the recoverability test. You will compare the carrying value of 800 with 795, and hence you say that the asset is not able to recover, and hence you go to the second step. But when you go to the second step, you directly compare the carrying value of 800 with the fair value 790, not fair value less cost to sell, not the value in use. And this is where the institute can kind of trick you into the question. So here the impairment is only 10. At a later date, if you want, subject to improvement in potential, you can reverse the impairment under IFRS. Reversal of impairment is not permitted under the US GAAP. Now again, if you want to look at the impact on ratios, what will be the impact on ratios? Well, in the year of impairment, whether it is US GAAP or IFRS, your net profit will fall significantly because of impairment, and hence your net profit will be lower. Well, if your net profit is lower, your return ratios, return based on ROE, ROC, which use net profit, etc., will automatically be lower. So your return on asset, return on equity, all of these will be lower because your net profit is lower. No sir, but that is in the earlier years. Now you have to remember that once impairment happens, your asset value falls. If your asset value falls, useful life remaining the same, depreciation will also fall. So let us say your asset was worth 100, impairment was, and useful life was 10 years. Impairment came to $30, in which case your asset after impairment is 70. Now 70, which is now going to be depreciated over the next 10 years, will have only a 7 depreciation, and hence your profit in later years will be higher because of impairment. Impairment took the 30 immediately, so your current year profit fell, and hence your current year ratios fell. But later years, typically, had there been no impairment, my depreciation would have been 100 divided by 10, that is 10. But now my depreciation is 70 divided by 10, that is equal to 7. And as a result, due to impairment, my later years depreciation falls, thereby my later years profit increases, and thereby your return ratios in the later years will be relatively higher. The same logic even applies for turnover ratios. When you look at the turnover ratios is sales divided by assets. Now, in the year when there is an impairment, what will happen is your total assets will shrink, and hence, as compared to a situation where there is no as compared to a situation where there is no impairment. Over here earlier, let's say your sales were 1000 and you were doing 1000 divided by 100. Now you do 1000 divided by 70, and hence your turnover ratio will go up. And this will also be the case in later years. Acha, why later years? Acha, ideally in the next year also, if your sales were 1000, you might have said 1000 divided by, for example, asset would have come logically 100 ke badle, they would have come down to 90. Now the asset is coming down to 63. Now 100 minus 10 ka depreciation would have been 90. Still 1000 divided by 90, my turnover ratio would have been 11.1. But now this is 70 minus 7. Yes, depreciation is lower, but still my asset is 63. So 1000 divided by 63 and you have a much higher relatively turnover ratio. So turnover ratios both for the current year as well as for subsequent years will be higher. Okay. Now there are also non-current assets which are held for sale. Here the treatment largely under IFRS and US GAAP is similar, where you compare the carrying value with the fair value less cost to sell. Even US GAAP says fair value less cost to sell. You don't have to compare it just with fair value. This is only if you intend to sell the asset. The sale is going to be highly probable, in which case you will compare the carrying value with the fair value less cost to sell, measure it similar to inventory and show a write-off. Once you record an asset as held for sale, you will stop depreciating it. There will be no further depreciation because it is now held primarily for the purpose of sale and not for the purpose of use, and hence there will be no depreciation over here. In this case, reversal, if required, is permitted under IFRS and probably under US GAAP as well. There's not specific guidance, I'm not sure, but in my opinion, it is permitted under both. It is best if you just check this point once. In earlier cases, I'm pretty sure that US GAAP does not allow a reversal. In this case, probably they do allow. Acha, when will I derecognize a long-lived asset? Maybe intangible, maybe PP. When will I derecognize? Well, I'll derecognize typically at the time of sale. And when I derecognize it, I'll compare the carrying value with the sale proceeds, and if there's any gain or loss, I can take it into the profit and loss account. Okay. In my cash flow from investing, sale proceeds will go, and the gain which would have gone into the profit and loss account is a non-operating item, and hence when I prepare the indirect method cash flow statement from my net profit, I will reverse the gain because it has gone into my net profit calculation, but it is not an operating cash flow. So I will reverse it. Even if it's a loss, I will kind of reverse it. Acha, if I abandon the asset, that is, I don't sell it, in which case my sale proceeds will be 0, which means there will be a loss. Again, this loss will be taken to the profit and loss account, and there will be no cash flow only. There will be no cash flow from investing because I've abandoned the asset. However, in my indirect method cash flow, there would be a loss on abandonment which would have reduced my net profit. Because it is non-operating in nature, non-cash in nature, I will add it back. Okay. And lastly, if there's a barter. Now, barter, IFRS US GAAP says, the asset that you are recording should be recorded the fair value of the asset given up, because that is what you are paying. But if that is not available, then fair value of the asset received. Basically, whichever of the two is more reliable. But typically, if both of them are equally reliable, then you will say that if I am getting an asset under a barter, what I'm paying for this is the real cost of the asset, and hence you will record the fair value of the asset given up. And if that is not available, only then will you go to the fair value of the asset received. Okay. Next, you look at certain ratios. Now, these are slightly different ratios where you are looking at fixed asset turnover. This is manageable. This is sales divided by total assets or average total assets, as the case may be. But then there are 2 or 3 other ratios, like you have the average life, total life, and remaining life. Now, these are a little common sense ratios. Now, you can always by heart and remember that, but if I were to take, let us say, a numerical, let us say you have original cost of an asset to be 30, accumulated depreciation to be 10, which means the carrying value is, let's say, 20, and annual depreciation to be 5. Now, if I want to find the average life, that has already gone by. What has gone by is now sitting inside accumulated depreciation. So, you will say accumulated depreciation is 10 out of the total, let us say, asset. However, how old is the asset? Now, if accumulated depreciation account has $10 and in each year $5 is taken, so 10 divided by 5, can I say 2 years? Accumulated depreciation divided by annual depreciation, that is 2 years. So, if your accumulated depreciation account, let us say, shows 0, that means the asset is brand new. Its life till now is 0. 0 years have passed by. It's a newborn asset, you can say. But if there's $10 in accumulated depreciation and there's $5 which is of annual depreciation, then you can say 2 years have already gone by. Second is total life. We say forget how much life has gone by, how much life is remaining, what is the total life? In which case you take the original cost. Let's say $30 divided by annual depreciation. So $30 divided by 5 will come to, let us say, 6 years. We'll say total cost is 30. Every year 555 is going out, and hence 6 years. May it will become 0, so your total life is 6 years. Okay, now then there is remaining life. Now remaining life can be calculated as 6 minus 2, that is 4. Alternatively, you can calculate the carrying value. You can say that out of 30, 10 got depreciated, so this is the life done, but 20 is yet to be depreciated, so this is the life remaining. 20 divided by 5, that is equal to 4 years, will be WDV divided by annual depreciation. You can see in each of these numbers, annual depreciation is divided. In the numerator, 3 different items are taken at one place: accumulated depreciation, one place original cost, one place WDV, as a case may be. So over here, this will be kind of relevant when you're looking at long-lived assets. Again, important thing for the purpose of forecasting over here is long-lived assets can kind of give you a perspective on what the capex, capital expenditure, company is kind of incurring. If your assets are outdated, or are your assets latest? If they're outdated, will I need more capex, etc. All of these analysis can be kind of looked at. This is a summary that we have tried to prepare on the differences in terms of IFRS and US GAAP. R&D, research in the P&L, development and capitalization IFRS. US GAAP takes everything in the P&L. But if it is software, again, there's no special guidance for IFRS. Under US GAAP, as we said, research goes in P&L. Capitalization for development, if it is for sale, when there's technical feasibility. If it is for own use, when it is probable to complete. When it comes to impairment, under IFRS, carrying value minus recoverable value, which is higher of fair value as cost to sell or value in use. But when it US GAAP, it is first recoverability test. If the carrying value is greater than undiscounted cash flows, then I go to the second step where I do carrying value minus fair value. That's it. Reversal is permitted under IFRS, but it is not permitted, let us say, under the US GAAP. Now, before we go into the long-term liabilities, we'll just kind of flip through if there is anything over here that needs some mention. Like for amortization of finite life asset, you will amortize it over the finite life on a straight line basis. If I look at indefinitely lived assets, they will be tested for impairment and annually. They will not be subjected to the annual amortization. Then you have a lot of these things regarding research, and you have things regarding impairment ratios, life, etc. I don't think there is anything significant over here. You can use the disclosures regarding useful life, depreciation method, etc. for the purpose of a better analytical framework. Next, we will go to long-term liabilities. Now, over here, the reading includes 3 items. One is lease, where there's a lot of literature. We'll say that that is important. Again, your favorite IFRS versus US GAAP conflict. Then there is pension liabilities, which they don't touch upon as much. They give you a general understanding, but this is something that is done at a lot more length when you go into your level 2. And third is share-based compensation. So largely a lot of focus over here is on lease. So let us review these long-term liabilities. To start with lease. Now under IFRS, there's a new standard called as IFRS 16, which is on leases, and under this standard you have been told that you will create for every lease other than a short-term lease, which is for less than or equal to 12 months, or having a purchase option, not having a purchase option, for every lease which is not a short-term lease, or it is not a lease of a low value item. Low value item has not been defined, but in general, if nothing is going, you will not assume the item is low value. So over here, in general, for every lease, they say you will have to create something called as a right of use asset and a lease liability in the books of the lessee. They've abolished the concept of operating and finance lease, at least from the lessee's books. In the lessor's books, it still remains. This is about IFRS. So let us say you were to take a property on rent for a period of 5 years. $100 is your rent per annum, and let us say your discount factor is at the rate of 10%, in which case we would say that approximately, let us say, if I were to calculate the present value of these cash flows, let us say $379 is the cost to acquire the right to use the asset. Remember, you don't own the asset, but you do have the right to use the asset, and hence you will have a right of use asset, let us say $379, for which you have an obligation to pay $379. Now in each year you will depreciate, that is, you will amortize your right of use, and hence $379 divided by 5, that is around 75.8 will be your depreciation in each of the years, or amortization as a case may be. Further, you will also record the lease liability. Now in case of lease liability, as each year passes, time passes, you will record the finance cost or interest. 379 into 10% will be your finance cost, and every year the $100 that is paid is going to be shown as the lease payment. So when I look at the lease under IFRS, at least, you will record this as if you are having a liability to pay, and for that liability you are paying certain amount. That is your cost of your right of use asset. So over here, when you look at IFRS, when I look at lease, whether you call it as a finance lease or operating lease, the CFA Institute sometimes uses that interchangeably. Just a second. They use these words interchangeably, the finance lease, operating lease as a case maybe, but if it is IFRS, you will create a right of use asset and you will also create a corresponding lease liability. Just a second. Okay, so over here, we will do a numerical for this also under both IFRS and US GAAP so that you are clear. Now, this is for all leases except if you are having a short-term lease or a lease of a low value item, in which case your accounting is very simple. Rent account debit to bank and then P&L account debit to rent. So, you will not record any asset, you will not record any liability, just rent account debit to bank. Now, this is in case of IFRS. Now, before you go into the numericals, what do you mean by a lease? Lease is where there is an identified asset, let us say, which is physically distinct, and you are getting substantially all economic benefits as a lessee from the usage, and you will direct how to use the asset, for what purpose to use the asset. All those decisions are taken by you, so you have the right to control usage, and hence you are going to show, let us say, a right of use asset. So when I look at IFRS, the same example, if I were to say $10,000, 10% is the discount factor and 5 years is a term, in which case your lease liability and ROU asset will be at 37,910. So your entry will be ROU asset account debit to lease liability. This working on your financial calculator you can get done, and hence in each of the subsequent years your depreciation will be 37,910 divided by 5. So this will be your depreciation in each of the years. But apart from that, there will also be some interest, because liability of 37,910, interest at the rate 10%, 10,000 is payment and you get closing. Like that, you will try to find the interest in each of the years. So when I look at this total amount, there is some depreciation which goes in the P&L. Depreciation impacts the operating profit, and there is some interest. Interest is after your EBIT, and hence it impacts the net profit, but it does not impact the operating profit. So if I look at the total expense that has gone, so these are the total expenses. Totally it comes to 50,000 only. You are paying 10,000 into 5, that is 50,000. Instead of showing this as a rent expense, you are showing depreciation and you are showing interest. But as you can see, the rent would have been 10,000 each year. Here in the earlier years, you have a slightly higher expense, but then in the later years, you have a slightly lower expense. So that will be helpful when you have to determine the ratios. Achha, if I were to look at the impact in the cash flow statement, at least under IFRS, the interest can be shown either as operating or as financing. So over here, interest can be operating or financing as 3791. And when you are paying, you are actually paying 10,000. See, depreciation is non-cash. You are actually paying 10,000. So out of 10,000, we can say 3791 is interest, which means the remaining 6209 is the payment of liability. Now this liability is like a long-term liability, which we kind of say it's like a loan, and hence this 6209 is like the repayment of loan, and hence this will be taken under financing. So over here, for sure 6209 will be financing, 3791 can either be operating or financing as the case may be. Okay, now this takes care of IFRS. Now the problem usually comes under US GAAP. Now US GAAP, being US GAAP, has certain slightly different treatments. So when it looks at the lease, it says that the lease can either be a finance lease or it can be an operating lease. So even in the books of the lessee, they recognize the concept of operating lease. We said no problem, we know operating lease means rent account debit to bank, P&L account debit to rent. No, US GAAP, they are going to do things differently, and hence the accounting has to be done in a slightly different way. So we'll see how it is to be done. First of all, we'll try to understand what is for finance lease. I will say this is exactly similar to what is there in IFRS as well. For right of use asset and lease liability, you record a right of use asset of 37,910, lease liability of 37,910, and then you will depreciate the asset over 5 years. Lease liability will show interest and payment. That's about it. Okay, sir, but when is it a finance lease? If one of the 5 conditions are fulfilled, that is substantially all risk and reward incidental to ownership are transferred to the lessee, which usually happens when, let's say, there is a purchase option, or if there is, let us say, a purchase option at a lower price, or automatic transfer of ownership, or lease term covers a major part, that is more than 75% of economic life, or the present value of lease payments substantially cover the fair value, or the asset is of a specialized nature. If these conditions, one of them is fulfilled, then it is a finance lease. Otherwise, we call this to be operating lease. The working will be the same, exactly the same. There is no difference over here. But when it comes to finance lease, but if it comes to operating lease, if one of the conditions are not met, then you will show it as an operating lease. Now, even if it is shown as an operating lease, no, US GAAP says you will have to create an ROU asset and you will have to create a lease liability. Now, student says, how does it work? Okay, we'll see a numerical on this. So ROU asset will be created and the lease liability will be created. The working for lease liability again will be that same table. Your opening 37,910 plus interest minus payment, and hence your closing will come. That same working will happen. However, when you look at the ROU asset, they have a very unique way to amortize the ROU asset. They say what is the principal payment in terms of a lease. Now, when you look at the principal payment, you say that in the first year over here 3791 was paid for the interest, but of course the total payment of 10,000, 3791 was paid towards interest, which means the remaining, I would say 6209 was, let us say, towards the principal. So that 6209 that is paid towards the principal is what is going to be used for the purpose of amortizing your right of use asset. So over here no one is going to pass you journal and ask you to pass journal entries, but they say ROU asset will be amortized and the reduction of the lease liability, by what amount lease liability reduced. So we says that in the current year you are paying 10,000, out of which 3791 is due to passage of time, interest, but the remaining 6209 that you are paying is exclusively for, let us say, the principal, and hence that is the amortization. So for some reason they don't do the direct straight line depreciation, but whatever is the reduction in the principal component that is reduction of the lease liability, that is going to be taken for the purpose of amortization. In this case, what goes into your PNL is still going to be 10,000 only. Sir, how 10,000? It is like amortization or depreciation in the form of, let's say, 6209 and 3791. I'm not going to take, let us say, the 7,000 or 7,500 of depreciation straight line. No, I'm going to take the same amount at which lease liability reduces into the PNL, 3791 into the PNL, and hence the total of, sir, in the second year 3170 will be there. Further, you can say out of 10,000, 3170 is attributable to the interest, which means that 6830 will be towards the principal, and as a result 6830 plus 3710 will be still 10,000. So what goes is just lease payment in total, which is what 10,000. This will go as an operating cash flow over here. There will be no depreciation, there will be no interest separately shown. So let us see. Same example in US GAAP. If it is an operating lease, your ROU asset and lease liability will still be 37,910. For your lease liability, your table remains exactly the same. However, for ROU, we will say that your amortization will be 6209. Sir, what is 6209? It is a reduction of lease liability. The difference between these two, 37 and 31, that is the reduction in lease liability. That is your amortization in second year, 31,701 and 24,871. This is exactly the reduction in lease liability, which is 6830 as we found. Similarly for the third, fourth and fifth year. So this will give you your amortization of your right of use asset. Achha, when I look at the US GAAP in terms of operating lease, your right of use asset will be 31,701. Basically it is same as lease liability. If you go to see, your lease liability falls, and that is the exact amount which is used for the purpose of amortization. If it is a finance lease, well, your ROE asset will fall due to straight line depreciation, so your values will be different. Lease liability under both cases is the same. So this is a numerical if you want to understand this operating lease concept fairly better. If I look at the operating lease, final lease payment will be 10,000 only in each of the years for the interest as well as for the remaining principal payment. Ultimately it's 10,000, so 10,000 only. But in case of finance lease, earlier there will be depreciation, there will be finance cost separately shown, in which case there will be higher cost in the earlier years, lower cost in the later years. So all of this understanding really helps you if, let us say, the question requires you to comment on the ratios. So if I were to look at a finance lease, let us say for US GAAP, or a general right of use and lease liability for IFRS versus an operating lease, for each and every one number, if I look at the right of use asset, see, remember, in terms of right of use asset over here, in the initial years the amortization under operating lease was 6,200 and something. That amortization was increasing. Earlier it was 6,200, then it became 6830, 7513 and so on. So initially there is relatively lower amortization in case of operating lease, and thereby your right of use asset is relatively higher over here as compared to over here. And hence if you go to see, right of use asset will be lower in case of finance lease. As you can see, in finance lease, your right of use asset, there is higher depreciation over here, and his right of use asset is 30,328. For example, if it is 37 minus that straight line depreciation is 30,000. Okay. Operating lease, it will be higher because in initial years, your lease amortization principal payment is relatively lower because interest is higher. It's a little complex. Again, this is something which will need more time for you to absorb. Lease liability will be same. Irrespective of the method that you follow in each of the years, lease liability will be the same. Now, what is the P&L impact? As you can see, under finance lease, in the earlier years, there will be higher depreciation as well as higher interest, and hence your expense will be more, and thereby your profit will be lower. So, over here, profit and loss will be lower. Under finance lease, 11,000 or something is your expense. As you can see over here, you can have depreciation of 7,500, interest of 379, 11,000 is the expense as compared to 10,000 over here. So in the earlier years, you will see that the expense over here is lower, and thereby expense is higher, so profit is lower. In the later years, the opposite effect happens. Your overall expense under finance lease becomes lower because your interest falls, depreciation, even if it is same, interest falls, so expense is lower, which means profit becomes higher. Opposite is for operating lease. EBIT is very interesting. See, impact on net profit is different, EBIT is different. If you look at operating lease, the entire lease payment of 10,000 goes as a lease payment, operating expense, and hence it reduces, the entire 10,000 is reduced while calculating EBIT. However, when you look at finance lease, only the depreciation part, that is 7,500, is reduced. So you will always find the operating profit to be higher in case of finance lease. Operating profit is higher because only amortization cost is reduced. Interest is after operating profit. This will be lower. Acha, interest cost, well, over here in operating lease there will be no interest. Over here there will be interest which is higher. Now when you look at cash flow, lease payment will be cash flow from operations entirely 10,000, and hence this will impact my cash flow from operations. It will be lower. But if it is let us say finance lease, then interest, even if it is US GAAP, can be operating. However, the principal payment will be taken as financing. So over here your CFO will be higher because there's a part which is going in CFF. So CFF will be lower. Over here your CFF will be higher. So this is kind of a very, very tricky and a detailed working. Hopefully you should be able to kind of make sense of it. Next you have ledger in IFRS as well as US GAAP. Thankfully the treatment over here is the same. In case of finance lease and operating lease, finance lease, whether it is US GAAP or IFRS, you will derecognize the asset, bring in the lease receivable. The lease receivable is brought in at something called as net investment, that is present value of lease payments plus the present value of unguaranteed residual value, and if there's any gain or loss, that is going to be initially recorded. So you derecognize the asset, show lease receivable at present value of lease payment plus PV of UGRV, and gain or loss will go in the profit and loss. If it is operating lease, you will not derecognize the asset. In fact, you will keep on recognizing the rent income on a straight line basis in the profit and loss account in absence of any other systematic basis. Okay, but if there's a dealer or manufacturer ledger, which means there's a ledger who is kind of a dealer or let us say a manufacturer, in such a case you will calculate in such a case you will do the calculation as usual, but there will also be some gross profit. So we have a numerical also that we have put in over here. You will try to calculate the gross profit. Like in this case, there will be inventory. You will have to book in the sales, you will have to book in the COGS, and you will have to book in the gross profit as well. So sales minus COGS will be the gross profit. Now let us say if I look at the finance lease and you are it's financing, there is unguaranteed residual value of 5,000. So the present value of unguaranteed residual value is 3,105. Acha, in our standard example, this is $1,000, $10,000, 5 years. Discount factor is 10%, so 37,910 that you are getting. No, but that is 10,000 that the lessor is going to get. Beyond that, he is also expecting to get 5,000 unguaranteed residual value. That will be a part of my lease receivable. So when I look at the lease receivable, this will be 37,910 plus the present value of UGRV. So this is 41,015. If it's a pure lease, not a dealer or manufacturer, I will record lease receivable at 41,015 to asset, whatever is the carrying value, and then gain or loss as a case may be, that will go in the profit and loss account. Okay. However, what if it is a manufacturer? Achha, if it's a manufacturer, maybe in my books the inventory appears at 30,000 and the fair value is 37,910. So over here there can be a slightly complex adjustment where you might say debit what comes in, credit what goes out. Well, the asset is going out, so inventory will be credited. But there is a credit sale, so there is a lease receivable debited sales which is credited. So lease receivable will be debited by 45,910. Now out of this 41,910, 10,000 is committed, you will get, but the 5,000 is not yet committed, and hence you can't book that as sales. So over here, if I had to record sales in case of a manufacturer lessor, I cannot say the entire 41,000 is sales, because over here, out of that 5,000 into the present value, that is maybe 3,105, you're not yet sure, and hence your sales will be recorded as consideration that the entity is likely to get, that is 37,910. Okay, but matching concept tells you that if the sales is recorded for 37,910, that is excluding UGRV, then the corresponding cost inventory is 30,000. So when I record COGS, that will also be reducing 31,015. So over here, what you are doing is you are passing two entries. One is a credit sale entry, which I have highlighted in green. Then is a COGS entry, which I have highlighted in red. When I pass a credit sale entry, it should be debtor account debit or lease receivable account debit to sales. But some of those sales have not yet materialized, and hence you are doing sales as 41,000 minus 3,105. Similarly, inventory, COGS account debit to inventory. So inventory of 30,000 is removed. That 30,000 should go to COGS. However, because I am saying that the entire sales is not yet materialized, and hence you will take 30,000 minus 3,105, and that's about it. So when you prepare your income statement, there will be some sales of 37,910, your cost of 26,895, and hence there will be some gross profit that will be recorded if there is a manufacturer or a dealer lessor, as the case may be. So this is regarding long-term liabilities and the longest section of long-term liabilities, which is on leases. Second, you have employee benefit expense. So over here, when you look at employee benefits, there can be some defined benefit plans or defined contribution plans when it comes to pension expenses. Over here, it's a little complicated, where they kind of say that if I'm looking at a pension expense, if my organization is committed to you that I'm going to pay you a particular amount, let's say half of your last one salary into complete years of service. Now the problem is, I don't know how many years of service you're going to complete. I don't know what is going to be your last one salary, but I'm giving you a commitment that I'm going to pay you this amount, in which case the entity is bearing what they call as actuarial risk. The risk that the liability might change and the entity is going to fulfill that liability. Such plans are called as defined benefit plan. On the other hand, sometimes what employers do is they just contribute some amount into the employee's account. So they say, whatever is your salary, let's say 12% of that, like a provident fund, I will contribute. In the US, sometimes they call this as 401k. So I'm going to contribute this into your account, and then beyond that, I don't have any obligation. You can decide which investment to make, where to make. I don't have any risk. So it's such plans where the employer is having a contribution or an obligation to merely contribute. Such plans are called as defined contribution plans. So when I'm looking at a defined contribution plan for an employer, the obligation is just to contribute. So if the employee has a $1,000 salary, 12% of that, that is $120, that is it. Employer contributes, and that's about it. Defined contribution plan accounting is very easy. You will just record the expense, and if it is paid, expense account debit to bank. If it is payable, expense account debit to payable. That's about it. However, when you look at the defined benefit plan accounting, the accounting is quite complex. So over here, you might have to do what is called as an actuarial valuation, which means you'll have to probably appoint an actuary, or you have to do your valuation yourself and estimate that how many years the employee is going to leave, remain in your service, what is going to be the salary when the employee leaves, etc. Because the risk of the liability remains on you. It is a risk of the liability that kind of remains on you. That is called as a defined benefit plan. And hence, in case of a defined benefit plan, what we will do is we will have to do the working in a slightly more complex way. To be honest, all of this calculation is done at a lot of length in your level 2. As of now, we just have to remember the broad understanding of what is going to happen. So over here, if I were to jump into, let us say, all of this pertaining to lease, we have kind of covered at a lot of length with numericals as well. So when I look at the defined contribution plan versus a defined benefit plan, over here, they merely contribute. Over here, the benefit is usually linked to years of service and compensation near retirement. Firm makes no promise to the employee regarding future payments. That's it. I'm going to pay 12% and that's about it. But here I promise that I will make this periodic payment. Okay. In this case, no asset, no liability will be recorded. It's just contributions which are going to be expensed. In this case, you'll have to record, let's just say, a liability that you have to pay. Sometimes you might even make investments like sinking fund investments, etc., in which case you'll have to record assets as well. very complex, but as of now you can just say there's a plan liability, there's a plan asset. Typically you will net them off. It is like saying that when you look at debtors and a provision for bad debt, you just show them net, because the debtor is going to, if it's a 100 debtor and there's a 20 rupees provision, you're going to get net 80. In a similar way, if there's a liability worth 100 and there is, let us say, a sinking fund, let's say bonds, US Treasury bonds that you've invested exclusively worth, let's say 90 on that, that means your net liability to pay is only 10. If 100 comes due, I can use my $90 bond which are earmarked for this, and hence it is only the net 10 which is my real liability. So asset minus liability, that is the net amount, will be your net liability if it's a credit balance, a net asset if it's a debit balance. So liability minus pension benefit, over here under both IFRS and US GAAP, the net amount will be reported in balance sheet. It is not that you will show the entire $100 as a liability and $90 an asset. No, you will do the net, and only the net $10 will appear in the balance sheet. Now when you look at for example kind of a few presentation layers over here, let's say the liability is 100, assets are 80, and hence 20 is a net liability. Such plans are called as underfunded plans, because out of the 100 liability you have funded 80 only, so 20 remains unfunded. On the other hand, the other way around, 100 and 130 are the assets, in which case 30 refers to the overfunded plans where you have a net 30 debit, which can be shown as a asset in the balance sheet. Okay, so over here there are certain workings, I mean just certain terms that you should be aware of. Like if there is a liability, that liability carries an interest. That interest, whether it is US GAAP or IFRS, will go in the profit and loss account. Further, because employee renders service each year, the liability may increase. Such expense is called as current service cost. Again, under IFRS as well as US GAAP, the current service cost will go in the profit and loss account. However, there is a concept called as past service cost as well. That is, if the employee has rendered service in the past, which suddenly becomes entitled to a greater level of benefit. Like earlier you were going to pay 1/2 of last drawn salary, now you amend the plan and say I'm going to pay 1 month of last drawn salary. That additional amount that I'm going to get for the service that I've already rendered is called as the past service cost. Under IFRS it goes under the profit and loss account, but under US GAAP that is adjusted through other comprehensive income. Now, like provisions, like liabilities can be remeasured at each balance sheet date to show the most recent assumptions. Even over here, what will happen is the actuary can change his assumptions at every balance sheet date, because you have to do the actuarial valuation, and any impact that is arising due to changes in actuarial assumptions is going to go through other comprehensive income. It's a remeasurement item, goes through other comprehensive income, both under IFRS as well as US GAAP. So if there are changes due to actuarial assumptions, they'll be routed through the other comprehensive income, both under IFRS as well as under US GAAP. So this is kind of a summary of the difference in the accounting treatments. Then you have share-based payment. Under IFRS, there is IFRS 2, where you have a share-based payment, where it's something like an ESOP, especially for your employees. You want to motivate your employees, and hence you give them a piece of your company. Either these can be share awards, where if the employee, let's say, completes certain vesting conditions. Let's say you are telling the employee to stay with you for 3 years. If the employee stays with you, let us say, for 3 years, then you are going to give the employee, for example, shares. This is called as a share award. In case of a share award, you will try to find the fair value of this share on the grant date. It's like a barter. You are telling the employee that you stay with me for 3 years. In return, I'm going to give you shares after 3 years. So I'm trying to find, like in a barter, in lieu of your service, I'm going to give you shares, and hence I'll try to measure your service through the fair value of what I'm paying, the shares that I'm paying. Sometimes instead of shares, I might give you options where I can tell you that after 3 years, if you stay, you can decide whether you want to buy or not. That is, you can exercise, pay some exercise price and get the share. This is an option. An option valuation happens using, let's say in derivatives, you'll study binomial, Black-Scholes, etc. You can value over here. You're doing accounting, so you don't have to do valuation over here. So you can find the fair value of the grant date of either the share, which can be done using a Gordon's formula, or options using, let us say, a Black-Scholes or binomial model. And this expense, this fair value will be spread over the vesting period, because in lieu of the service over 3 years, you are going to give shares, and hence this expense should not be recorded immediately, should not be recorded after 3 years. In fact, they should be recorded over 3 years. Again, in share-based payment, there can be a concept of a share appreciation right as well, where you might even cash settle by paying the appreciation amount. Even over here, the working remains the same. You'll have to determine fair value, just that the fair value will be determined at each balance sheet date, and you will spread that over the vesting period. So over here, this will take care of this reading pertaining to long-term liabilities. Again, this is regarding certain disclosures regarding to share-based compensation or other long-term liabilities, the disclosures that need to be shown. And then among this most important section, the last part which is there is on income taxes. Now, in income taxes, you'll have to kind of, this is again pertaining to your calculation of current tax, deferred tax, etc. So when we look at income taxes, over here, usually you will calculate the tax that is payable as per, let us say, the income tax laws. Let's say in India, there is an income tax act, US has the tax code. So you calculate your tax as per the income tax provisions. However, in your books of accounts, you prepare your financials, that is profit, etc., as per your books of accounts principles. So that creates a problem. Now, there can be some differences in terms of profit measurement in books as compared to the profit measurement in income tax, and as a result, your accounting profit may be different from income tax profit for something which is as basic as depreciation. Like over here, if I were to take a very basic example, your profit before depreciation in books and income tax is both 100. However, income tax requires you to charge depreciation of an asset, let us say fully. So let's say there's an asset of 100, books has 25% SLM, income tax has 50% SLM, in which case the profit as per books comes to 75, profit as per income tax comes to 50 after charging depreciation. Now, tax is at the rate of 30%, and hence your current tax expense as per income tax records will be 15. However, if I look at, let us say, the books of accounts, if I just take 15 as an expense, the reader would believe that on a 75 profit, you have made only 15 of tax cost, which is wrong. Why? Because you are paying lesser tax now. Ideally, you should be paying 75 into 30%, that is, you should be paying 22.5. However, you are paying lesser tax now because you're getting more depreciation as per income tax, but that will wear out, and hence you'll get lesser depreciation in the later years. Now, that will make you pay a 30 rupee tax in the last 2 years, and hence what you're paying less now, let's say instead of paying 22.5, you are paying 15, so you're paying 7.5 less in year 1 and year 2 each. You'll have to pay more in the later years, and hence what you are doing in initial years is you're not really saving tax, you're just pushing, that is postponing or rather deferring tax. So the base for deferred tax is that your profits or your balance sheet values as per books and income tax will be different, and as a result, the difference between those will give birth to deferred tax, provided those differences are temporary. Now, these differences can be temporary, there can be other than temporary, like for example, difference due to depreciation can be a temporary difference, or maybe preliminary expenses, books gives you immediate deduction, income tax gives you deduction over 5 years, temporary difference. All these differences can be permanent, like a donation to a charitable institution is disallowed under income tax permanently, and hence that deduction, I mean, books does not care whether it is an unregistered or registered charitable institution, it gives you a deduction. Income tax does not. So this difference is permanent, or also called as other than temporary difference, in which case, if let us say there is a disallowance, you'll end up paying more tax. That is not just a temporary payment of more tax, it is an actual excess payment of tax, and hence you don't create any deferred tax for a other than temporary or permanent difference. However, you will create deferred tax for temporary differences. So when I'm looking at, let us say, certain key terms, taxable income is an income as per tax return. Taxes payable again will be based on the taxable income which is as per the tax return. Tax base is the amount appearing of the asset or the liability, as the case may be, in the tax balance sheet. So if I were to look at an asset of 100 and let's say there's a 50 rupees depreciation, then the tax base in the tax balance sheet will be 50. 100 minus 50, that is the asset will appear as 50 in the tax balance sheet. Net amount appearing as per the tax books. Income tax expense will be the total of current and deferred tax expense. So over here, I'm just trying to say that 7.5, I am not really saving, I'm just postponing. So I'll create a deferred tax liability. My entry would be deferred tax expense account debit 7.5 to deferred tax liability, and hence in my PNL I will show 22.5. Out of this 22.5, 15 rupees is current tax, whereas 7.5 is deferred tax. So deferred tax arises because of temporary differences between the books and income tax. If these temporary differences result in me paying more tax now, in me paying lesser tax now, like in the current case, thereby making me pay a higher tax in the future years. Paying more tax in the future is like a liability. So that creates a deferred tax liability. On the other hand, if the opposite works, that is, over here I'm paying more tax now. Like let's say in India it is, there is section 43B which disallows certain expenses if they have not yet paid. Books does not care about that. So if interest to a scheduled commercial bank you have paid or not paid, in books you will get a deduction, but income taxes will give you a deduction only once it is paid. So this is an example of a temporary difference. Like in the books, you have taken a deduction. Income tax you have not. If you have not taken, that means your profit is higher, which means you'll pay more tax in the current year. But in the next year, when you pay that interest to the bank, you will get a deduction, which means you'll pay lesser tax in the future years. So basically, there are two types of deferred tax items. Either you will pay less tax now, that is, you will pay more tax in the future. Like our depreciation example, this creates a deferred tax liability. Or you will pay more tax now, like in our section 43B example, you'll pay more tax now, thereby you'll pay lesser tax in the future, in which case that's a deferred tax asset example. These differences are temporary and hence they give rise to a deferred tax. If these differences are permanent, they don't give rise to any deferred tax working. So there's a deferred tax asset or a liability. Deferred tax asset results if your tax payable is greater than tax expense. DTL if tax payable is less than your overall tax expense. So in deferred tax liability, you are paying lesser tax now as compared to what you should be paying. So that's a deferred tax liability base. Now, under US GAAP, valuation allowance is there only under US GAAP. It is not there under IFRS. Usually, when you create a deferred tax asset, it's deferred tax asset account debit to profit and loss account, and hence it is in a way a contingent asset. Deferred tax asset can only be in a way recognized if you believe that you will get sufficient profits in the future years against which you can utilize these deductions. You believe that you will get sufficient profits, then you can recognize a deferred tax asset. However, in the later years, if your assessment changes, you now believe that you will not be in a position to generate those sufficient profits, in which case you will not, in this case, you will not really consider showing a deferred tax asset. No, but you have already created it. IFRS says you reverse it. IFRS says that if you now believe that profits will not be earned, then whatever deferred tax asset is created will have to be reversed, because you will not get a deduction. And even if you don't earn profits, you cannot say that I'm going to save tax by paying lesser tax. No, you're not going to make profits. But US GAAP says if deferred tax asset is created, let it be. I will create a separate valuation allowance. So if there's a deferred tax asset of 30 rupees, I will create a separate valuation allowance. Let's say I'm assuming no profits, then I'll create the full valuation allowance of 30. My entry will be, let us say, P&L account debit to valuation allowance. When I present my balance sheet, in my balance sheet, I have a deferred tax asset minus, let us say, valuation allowance under US GAAP. So this is a contra account for DTA. If DTA is not expected to reverse, valuation allowance is created. Okay, so as we have discussed the reasons for DTA, it can be difference between accounting profit and taxable income, and that may be due to temporary factors. There can be various reasons like depreciation, revenue recognition principles, matching concept, etc. There can be a lot of reasons where there can be a birth of a deferred tax item. Okay, how are deferred tax items created? We said they are created due to temporary difference. If those temporary differences like depreciation result in you paying lesser tax now but more tax in the future, that's a deferred tax liability. If those differences result in you paying more tax now but lesser tax in the future, that's an asset for you. That's a deferred tax asset. Okay, so over here the question is, if you look at deferred tax liability, for example, how do you treat it? Well, we treat it usually like every other liability, provided you believe that I'm paying lesser tax now. That is, I'm paying 15 rupees, but I'll have to pay more tax in the future. Now I'm paying 15 instead of 22.5 in my example. Instead of 22.5, I'm paying 15. But in the future years, instead of paying 22.5, I'll end up paying 30. So I'm expecting that I will end up paying more tax in the future years, and thereby there's a deferred tax liability, which is a real liability. However, for certain companies which are highly growing, they're growing very fast, they're keeping on adding more and more and more of assets, in which case sometimes what happens is, in a highly growing company, that reversal gets pushed and pushed deep into the future. In which case, we'll say that if the reversal is highly unlikely in the near term, or if the reversal is pushed deep into the future, then this deferred tax liability is not really a liability right now, in which case the institute says that you can, for analysis purposes, consider it as equity as well, because you are not going to be required to pay it, in which case it can be considered as an equity. So deferred tax liabilities that are not expected to reverse because of capital expenditure, etc., should be treated as equity, but if they are expected to reverse, then they will be treated as liabilities. Okay, then you have certain calculations and interpretations. So there are three tax rates. One is something called as the statutory tax rate. That is a tax rate prevailing in the country. Then is the effective tax rate. What is effective tax rate? Effective tax rate is a tax rate that you are going to effectively pay, considering, let us say, your current tax as well as temporary differences, so deferred tax. So over here, all said and done, what is the tax rate you are ultimately, and so it is income tax expense divided by accounting profit. Income tax expense is current tax plus deferred, plus or minus deferred tax expense or income, as a case may be. So that divided by the accounting profit will give you the effective tax rate. Now the problem is sometimes your statutory tax rate and effective tax rate may not tally. Now why will they not tally? Some students jump to the conclusion, they will say they will not tally because of deferred tax, which is wrong. Remember, deferred tax in fact tallies that. So over here, if I look at deferred tax, well, I have 22.5 as income tax, which is 15 plus 7.5, and if I compare 22.5 with 75, that is exactly 30%. My statutory tax rate is 30%. My deferred tax, my income tax rate is also 30%. However, in certain cases, like if the differences are other than temporary, like there are permanent differences, in case of permanent differences, my working may not tally. Why? Because, well, I might actually end up paying more tax if there are certain permanent disallowances, or I might save tax if there was some weighted deductions which I get, and hence there may be a reason where I'll have to show a reconciliation between my effective tax rate and my statutory tax rate. A reason for those differences can very possibly be the reason for those differences can very possibly be uh, uh, permanent differences. Other than that, another reason for those differences can also be that different incomes can be taxed at different rates. Now, there may be one statutory tax rate in India that is 30%. However, you might be earning certain capital gains tax incomes which are taxed at 10%, other incomes which are taxed at 30%, and hence your effective tax rate might be slightly different. Or you may be a multinational company and you might be operating in various jurisdictions, and each of these jurisdictions have different tax rates. So in US 35%, India 30%, let's say in Singapore 15%, and hence your composite profit may be taxed at a different rate. I mean, your effective tax rate may be different because you might be an Indian company, but you might have operations at various places, and those different places have different tax rates. And as a result, when you are actually calculating uh, your effective tax rate, there can be various reasons. I'm not sure whether it is written. Yes. So the reconciliation will have to be shown between the effective tax rate and the statutory tax rate, which is largely due to permanent differences or differences in tax rates in different jurisdictions, or differences due to different natures of income like capital gains and other incomes which can be different. So over here there is a statutory tax rate, which is a corporate tax rate in which the company, in the country in which company is domiciled. Effective tax rate is the income tax expense divided by the pre-tax income, which is income tax expense is current tax plus or minus deferred tax. And then there's a cash tax rate, that is how much tax is paid divided by pre-tax income. So over here, when I calculate the effective tax rate, that is income tax expense, that is current and deferred together, divided by the pre-tax income, that will have to be reconciled with the statutory tax rate. So the question, I mean, the requirement is there has to be a reconciliation with the rate, and the reconciliation items over here will largely be due to these items, for which you'll have to give, let us say, a reconciliation. Apart from that, in your financials, there'll be a lot of disclosures regarding deferred tax liabilities, assets, valuation allowance, if any, tax loss carry forward, if any. And that ways, remember, you're not really solving a tax paper over here. You are doing a financial statement analysis and having a broad understanding of deferred tax, that it arises due to temporary differences. When is there a deferred tax liability? When is there a deferred tax asset? Deferred tax asset, for you to recognize, there should be reasonable certainty in profit. If it is not there, under US GAAP, you create a valuation allowance for that uncertainty. If, let's say, there's a deferred tax liability which is not expected to reverse in the foreseeable future, then you show it as equity for analytical purposes. If it is likely to reverse, then for analytical purposes you continue to show it as a liability, etc. So over here, I mean, there is a numerical that we've kind of done to reconcile. Like the statutory tax rate is 30%, effective tax rate is also 30%. In our example, there is no need of a reconciliation. However, maybe there is some donation which is a permanent difference, in which case you will say that in your books your profit will be 65. In income tax, your profit will be 50. So your current tax will be 15 rupees. Now that 15 rupees, if I divide by 65, 15 divided by 65, it is 23.03%. Okay, but that is 15. Apart from that, there will be some deferred tax. Yes, there will be a 7.5 deferred tax which will be created on this 25 ka difference. 25 and 50 ka difference is 25 into 30%, that is 7.5. So 15 and 7.5, 22.5. 22.5 divided by 65, if I do, that is around 34.62%. So over here there is 22.5 upon 65, effective rate is 34.62%. Well, your statutory tax rate is 30%. Now why is there a difference? Well, the difference is because there are certain disallowances of 10 rupees on which you end up paying a 30%, that is 3 rupees tax. So you can say that on accounting profit, ideally 65 rupees which is there into 30% will come to 19.5. However, you are paying more. Why are you paying more? Well, because 10 rupees is disallowed, and hence 10 rupees into 30%, that is 3 rupees, will be a further payment, and hence 22.5 is your effective income tax expense, and your tax rate over here you have tried to reconcile. Remember, you're not going to be asked to prepare a reconciliation statement. Again, it is an MCQ based paper, but this kind of helps you in a understanding for this income tax. So as we can see, this is kind of a fairly intense section. We have spent a lot of time, more than an hour, just covering these 3-4 readings, because this is the crux in my understanding. After this, you go to the last section of your FSA, where you are going to study about financial reporting quality, then different financial statement analysis ratios, and at the end, let us say, regarding forecasting, what is the methods, etc., that you use for forecasting. So let us go into the last 3 readings and get done with this very important session. Okay, so if we go into financial reporting quality, so when we look at the financial reporting quality, there are 2 things that you are looking at. First is the quality of reporting, that is, are you complying properly as per GAAP, maybe US GAAP if in US, or internationally then IFRS. So you will look at the GAAP compliance, that is the first thing, and are these statements that you have given useful for decision making. First of all, you are complying with GAAP. And secondly, are you reporting in a way where the data that is given is useful for decision making? That is the data presented in a faithful, is it a faithful representation of what has happened? And are you showing all the relevant information? If that is there, all the material information which is relevant is shown, and faithful representation, that is you are neutral, you are not biased, no errors are there. So that is when we say that the report is of a good quality. Now, merely because the report is good quality does not mean that the company is of a good quality. Maybe the company is perennially loss making, it is losing money. You are doing proper reporting, you have shown everything properly. But for you to have good quality of earnings, see, there is one is financial reporting quality and second is quality of earnings. Now, for you to have a company which has good quality of earnings, these earnings should be sustainable. They should be profitable and they should be sustainable. Now, merely because you are following GAAP does not mean your quality of earnings is good. So, your ideal company is a company which has sustainable growing earnings and it has a good quality of report as well. In your spectrum, that is considered to be kind of the best ideal company that as an analyst you should be looking for. So over here, quality of earnings means the level of earnings is kind of growing and these are sustainable earnings. So if you look at the spectrum, that means the best type of companies will have the best financial reporting quality. So that is proper compliance, everything done. And at the same time, they will have sustainable, that is growing earnings. So this is GAAP compliant reports plus sustainable earnings. Where is the worst quality in the spectrum at the other side would be where you are not compliant, you have tried to do, you have done a lot of violations, like what happens with Byju's, if you are aware, and at the same time, you have put in a lot of fictitious transactions. So your earnings are not sustainable, they're not like real earnings. So this is kind of the worst type of a company, whereas on what is there on the left hand side is kind of the best type of company. Now, when you look at the financial reporting quality, what are the accounting adjustments that you can do which can impact your neutrality? Ideally, your accounting has to be unbiased, that is, it has to be neutral. However, there can be certain adjustments that can be done whereby you can say that your accounting is aggressive. What do you mean by aggressive accounting? You're trying to increase the profit of the current year. You're trying to show more profit, or you're trying to show more assets. That is what is aggressive. And conservative means you are trying to be prudent. You are trying to show, let us say, not excessive profit. So maybe you are trying to show lower profit. You're okay with even lower assets. So when I look at methods which can result in aggressive accounting practices being applied, maybe preponing revenue recognition, maybe if you have not even done your performance obligation and you are recognizing revenue, or capitalizing expense instead of writing it off in the profit and loss account. These are the 2 most common things when it comes to you trying to manipulate. So over here, capitalization of expenses will kind of postpone expenses. I mean, you will have to depreciate and thereby increase the current period profit. Remember, all of this comes at a cost of later years. So, but people don't look at far-sightedness. Current year, let me get a good profit. What did I do? Chalo, capitalize expense. Or let us say I will accelerate my revenue to be recorded. Or let us say depreciation. I will take a longer useful life, the easiest way, longer life of PP, so depreciation will be lower. or I assume a higher salvage value, thereby depreciation is lower. WDV usually has a greater depreciation, SLM is having a lower depreciation. If I see indicator, I'm still not testing for impairment, so I'm delaying my impairment. I create a lower provision for bad debts, lower valuation allowance. These are just a few examples. Remember, this by no means is exhaustive, but these are aggressive practices. Acha, conservative practices will exactly be the opposite. Like you are expensing out, things should be capitalized, you are still expensing it. Shorter life of PP or a smaller salvage value, WDV based depreciation, early recognition of impairment, a higher provision for bad debts or valuation allowance. Usually, typically, investors are happy if the accounting practices are conservative. Management is usually happy if the accounting practices is aggressive. Well, why does management typically want to have uh, aggressive? Largely because the management believes that a lot of its income, its compensation is linked to the profit. So management has a lot of incentive in first getting their promotions, uh, getting their bonuses, and hence they want to show a higher profit in the current years. In later years, maybe if I'm management team, I must have left the company also. So I'm currently looking for getting a higher compensation, and hence the management wants to usually incentivize to kind of increase the profit. One of the most common ways in which profits are increased in practice is in years where you have actually a higher profit. Now, management tries to smoothen earnings. They don't want to see 1 year where there's a lot of profit and then second year there's lesser profit, so people are questioning them. So management smoothens the earnings. And how does management smoothens the earnings? Management will create provisions. Currently, let's say in my current year, I've made a lot of profit. So what I'll do is by the end of the year, I'll create a provision. Now, expense account debit to provision, so my profit falls. Now that is kind of just a provision on paper. So in the next year, when my profits are relatively lower, I will reverse the provision. I will think that, oh, this expense is not going to happen. So provision account debit to P&L. So that way, in the year when there was higher profit, I smoothened and thereby I reduced the profit. That is not fair. That is not correct. But nevertheless, I did that. In the later years, when the profit is relatively lower, I kind of reverse the provision and thereby created a profit. So management smoothens the earnings, that is creating accrued liabilities or provisions. In period of high profits, create provisions which can be reversed later. In periods of low profits, will reverse the provisions. Okay, what are the mechanisms which can be used for the purpose of ensuring financial discipline? First is regulators. There should be regulations and there should be stringent penalties to enforce those regulations. There should be auditors who should be kind of unbiased. Again, the problem is the management pays the auditors, so how much they remain unbiased is again questionable. But there should be auditors who will be unbiased and should give a fair view. And there should be private contracts. Like for example, in case of a debenture contract, there should be certain covenants which kind of ensure that the financial reporting discipline is kept. So this will kind of ensure that your reporting quality is good. Other than that, what the managements a lot of time do is, if their profits are not up to the mark, they show some non-GAAP measures. Non-GAAP measures means something like EBITDA. EBITDA is a very popular measure, but if you look at the income statement in the format, EBITDA does not come. I do EBITDA. More dangerous, adjusted EBITDA. You adjust it for one-time items and you show it separately in your investor presentation. Now, you want to show that so that the readers just focus on that number which is good. So these are non-GAAP numbers, and both IFRS and especially US GAAP looks at non-GAAP numbers with a lot of suspicion. So they say, well, you have found adjusted profits. What are those adjustments? Reconcile it with the GAAP number. So if you show non-GAAP measures like adjusted EBITDA or a free cash flow, etc., then there is a need to reconcile with the closest GAAP number. So what is the closest number that is to be reported as per GAAP? You have to reconcile it with that, like profit before tax. Then you reconcile it with why is this number different. Reconciliation between GAAP and non-GAAP, this is required for both IFRS and US GAAP. In fact, in US GAAP, there is a Sarbanes-Oxley Act or SOX, which requires a lot more kind of presentations and disclosures for this matter as well. So as we were discussing, there were few important items which managements typically use, where they have given you examples over here. So for revenue, you can use, you can manipulate and you can take free on board, or you can have bill and hold arrangements or channel stuffing where you want to show sales. So in your channel partners, your distributors, you are just pushing your products. You are telling them that if it is not sold, you give it back to me. But currently I want to show sales. So you're just stuffing. Bill and hold. So you have prepared a bill, but you're still holding the inventory. Now all of these are aggressive practices. In bill and hold, what happens is the inventory is still with you, but you have raised a bill before the balance sheet date so that you can book the revenue. In channel stuffing, you have given the inventory now, but you have given it to your distributor only. It's not your agent, it's a distributor, but you have told him that if it is not sold, you give it back to me. So all of these are aggressive revenue recognition practices which can increase your revenue, increase your profit, but may not be of good quality. That report may not be of a good quality. Provision for bad debt or provision for warranty. Acha, if I want to reduce my net profit, I can say that, oh, many people will come for repair and I'll create a more provision for warranty, or more debts will go bad. If I want to reduce my, if I want to increase my profit, I will either reverse or reduce my provision, as the case may be. Okay. Similarly, valuation allowance. Again, valuation allowance for DTA is to be created if I believe that sufficient profits will not be earned in the future years. But again, that is based on my assessment. If I want to kind of reduce my profits, then what I will do is I will say, oh, profits in the future are not very certain, so let us create a valuation allowance. And if you create a valuation allowance, it is P&L accountable to valuation allowance. Or at a later year, if I want to kind of increase my profits, I can say, no, now I think foreseeably I will earn a lot of profit. So you will reverse the valuation allowance. So valuation allowance will be debited, P&L will be created. So increase valuation allowance if I want to decrease the profit, decrease valuation allowance if I want to increase the profit. And again, all of this is subject to subjectivity. Achha, depreciation, I mean, straight line method, you can just increase the life to reduce the depreciation and thereby increase the net profit. This can also happen in terms of salvage value. Achha, amortization or impairment, you can delay and say that there's no indicator, and you can delay the impairment testing. For inventory, as we had discussed earlier, you can change your method from, let us say, FIFO to weighted average, or let us say LIFO. For example, if I want to increase my profit, switching to FIFO is a better technique. If I want to decrease my profit, then switching to LIFO is a better way, and hence I can kind of play around like that. And if there's a lot of changes that are happening, then the investor realizes that the report may not be of a good quality. Achha, I can even use related parties, where I can kind of transfer the profits from a listed company to a related party of the promoters. Like, for example, a listed company buys products at 100. Ideally, it will sell it at 120, but I sell it to my related party at 101 rupee. So the listed company only makes 1 rupee, and then that related party sells the product at 120 and eats up the 19 rupees. So this is at the cost of the minority shareholders. So this can shift the profits by making sales to related parties at the lower price. All of this is something which, as an analyst, you have to see to figure out. Like in Adani, Hindenburg had written a lot of such things. Whether it was true or not, no one knows, but nevertheless, that can kind of put questions on the quality of financial reporting. Achha, if you have capitalization, if you increase the capitalization, it increases the net profits because it reduces the expenses, but it also increases the assets. So people love to capitalize. Why? Because net profit in the current year will be higher, assets will also be higher. Achha, my CFO will also be higher because my payment, if it is not an operating expense, it will, if it is an investing item, it will go into investing activity. So it is like the absolute best for companies wanting to show more profits, that is capitalize the expense. That ways you are able to increase your profit, you are able to increase your assets, you are able to increase your cash flow from operations, and you can show growth by showing a cash flow from investing which is negative. Okay. So maybe you can use other methods, like you can stretch the payables. You are not paying to your suppliers, that thereby your cash flow may be higher. You might, oh, you have good cash flow from operations, but that is you're not paying to your payables. Or interest can be capitalized, interest or dividend, you can kind of play around between. Rather than showing in operating, you can show it in, let's say, investing or financing, maybe in case of IFRS. So these are all these things which can impact, let us say, various financial reporting quality. So this kind of takes care of this financial reporting quality, where I think if we'll see if this is regarding that spectrum, where we are saying that the best will be if I have the good quality report and sustainable earnings. Various aggressive and conservative policies are given over here. Motivation for managers usually is for career considerations, increase their compensation, etc. If, let's say, so the problem is, why would manager issue reports? I mean, they can issue if they get an opportunity. They have the motivation. The motivation is like to increase their compensation. Opportunity is like weaker internal control, and they can always rationalize. They are saying that this is, let us say, because I want to take a loan from a bank, or I want to do an IPO, that is what I am doing. So this is why maybe a bad report might come in. Mechanisms can be through regulation, enforcement, auditing, private contracts, etc. Non-GAAP measures, we said, usually I can give this in investor presentation reports, kind of to divert my investor attention into a non-GAAP measure if my GAAP numbers are not up to the mark. Various like valuation allowance, depreciation method, inventory cost flow, related parties, all of this is there. And describe accounting warning signs and detecting manipulation. Okay, if you keep on frequently changing revenue recognition methods, or let us say your turnover ratios change very frequently, you enter into a lot of barter or related party transactions. Your PAT, we discussed earlier as well, your PAT and cash flow from operations are not in sync. Like your PAT is growing, cash flow from operation is falling. Maybe you are booking fictitious sales. Capitalization decisions which are questionable, frequent non-recurring items, you are emphasizing more on the non-GAAP measures. All of this we can say are going to impact our financial reporting quality. So all of this largely we can say is more of a theory based assessment, analytical assessment. And next you go to the financial analysis techniques. Now largely this chapter is entirely ratios. So if you have done, let's say, ratios in your intermediate, etc., this is kind of a sail through. Most of those ratios is something that you have seen. So we'll quickly glance through those ratios. Maybe we'll try to figure out when a particular ratio, higher the better, lower the better, more emphasis on a ratio like return on equity, and that's about it. The last chapter after that is for financial modeling or forecasting. That is a few theory things, and that's about it. So over here, when you're looking at financial analysis techniques, over here for doing financial analysis, a lot of techniques like doing a trend analysis or doing, let us say, something which is ratio based comparison, common size financial statements, graphical presentation, tabular versions can be done for financial statement analysis. Now in financial statement analysis, you are trying to gather the data, process it, analyze it, make it comparable, all of that to come to that conclusion. Like for example, if I'm a credit rating agency, what is the credit rating to be given? If I'm a lender, should I give the loan or not? If I'm a research analyst, what is the target price rating I should give, etc. If I'm an M&A company, how much should be the consideration I should be paying? So I will try to find a lot of data, process, analyze it, and come to the appropriate conclusions. And some of the best tools for doing that analysis is ratios. So when I look at ratios over here, these ratios on their own may not be meaningful, but if I compare it on a time series basis, that is for that same company, I compare it over the years, or if I compare it cross sectionally, that is with other players in the industry, that can give me very insightful information. So over here there can be ratios. As we said, one of the tools is the vertical common size statements, which are for income statement a percentage of sales, balance sheet a percentage of assets, for cash flow it can be a percentage of sales or maybe percentage of cash inflows or outflows as the case may be. For horizontal statements, which is what we have not discussed, we present each item as a percentage of the base year. Like what happens in national income, something like that, you will take a base year and everything will be a percentage of that base year. So that is for a horizontal size common statements. Ratios cannot be viewed in isolation, they have to be used in conjunction, and you compare it with different companies, different time periods, and that will give you much more relevant data to understand. So over here we need to figure out whether ratios higher the better, ratios lower the better. Again, there's no law or there's no requirement which prescribes how a particular ratio is to be calculated. So you as an analyst have to figure out whether the ratio is calculated using a particular basis, and if that basis is reasonable or not, that is something that you need to kind of do. So various tools that are available is ratios, common size statements, graphical presentation, and even regression for the purpose of forecasting. Now there are various ratios. Now when I look at the ratios, I'll classify the ratios into 4 categories. One is activity based ratios, so these are usually the turnover based ratios. Second, you have the liquidity based ratios. Activity based ratios like inventory turnover, fixed asset turnover, debtors turnover, they tell you on how well you are utilizing a particular asset. So these are ratios which tell you about utilization. Then you have liquidity ratios which tell you that does the firm have immediate cash or immediate liquidity to pay off its liabilities. So these are liquidity ratios. And then there are solvency ratios, that in the long term is a firm likely to remain solvent. So ratios like debt to equity, capital gearing, debt to assets are called as solvency ratios. Current ratio, quick ratio are called as liquidity ratios. So when you look at liquidity ratios, these are ratios to meet the short term obligations. Solvency ratios on the other hand are to meet the long term obligations. Then there is profitability ratios. Now profitability can be viewed vis-a-vis sales, like the margin ratios, NP margin, GP margin, operating margin, or they can be viewed vis-a-vis investments, which are the most important ratios, at least from a equity analyst perspective: the return on equity, the return on capital employed, the return on assets, as a case may be. So profitability ratios can be linked to income, that is a return on sales, or it can be a return on investment as well. And then there can be certain valuation ratios like multiples, price to earning, price to sales, etc. These are relative valuation. Now when you look at these ratios, a few things that you need to remember. First of all, these ratios, if they are a pure ratios, that is in the numerator and denominator, there is both income statement item, like a net profit margin. You have net profit in the numerator, sales in the denominator, both from the income statement, then you don't need to do any adjustment. Or they are pure balance sheet items like current ratio, current assets and current liabilities, no adjustment needed. However, there can be certain mixed ratios, like for example, certain turnover ratios, like sales divided by fixed assets. Now, sales is from the income statement, fixed asset is from the balance sheet, and hence they are not directly comparable. And hence, in such cases, you will average out the balance sheet items. So, you will take the sales divided by average fixed asset, for example, or the return on equity. You take the net profit, which is the P&L item, and then the equity funds, which is a balance sheet item, and hence you will find the average equity funds in case the ratio is, let us say, a mixed ratio. So when I'm looking at these activity based ratios, various ratios, I mean, we just discuss that quickly, otherwise you just have to refer this. This is inventory turnover. Inventory turnover will be COGS divided by average inventory. Again, higher the better, because that is better utilization. Debtors turnover will be sales, or rather credit sales, divided by, let's say, average debtors. Again, higher the better, because that shows better collection. Payables turnover, that is, let us say your purchases or credit purchases divided by your average payables. In this case, generally the higher the better, because the creditors can give you more credit. However, if it is exceedingly high, it may show that you are not paying the payables, which is not a good thing. Otherwise, there can be fixed assets turnover, that is sales divided by average fixed assets. Working capital turnover, sales divided by average working capital, as a case may be. All of these ratios, higher the better. It just shows that for 1 rupee of fixed asset, how many times sales you are generating. More the better, that is better utilization. Now, sometimes, especially for working capital ratios, you can take the days outstanding, like for example, inventory turnover. I mean, that is in terms of turnover. It is how many times in a year that is kind of turned over. It's really difficult to comprehend. So people calculate the days of inventory on hand. How do you calculate? Well, you usually take the inventory turnover inverse into 365. That's it. Debtors outstanding, well, debtors turnover inverse into 365. Payables period, well, that is payable turnover into 365, you will get it. Now, sometimes you might be asked to calculate operating cycle or cash to cash cycle, in which case what you will do is, you will take operating cycle is the time it takes for you to, from the time you pay cash till the time you get back cash. That is usually your inventory number of days that your inventory is held, plus credit period, number of days that debtors take to pay you back, minus the number of days that the creditors gave you credit. That is called as your working capital cycle or a cash to cash cycle. The shorter the cycle, the better it is. Okay, so these are regarding your first set of ratios. Then you have liquidity ratios. The easiest, current ratio, current assets upon current liabilities. Higher the better, because that shows more liquidity, more safety. Quick ratio, well, you take quick assets, like you don't take inventory, you don't take prepaid expenses, because they are not quickly convertible into cash. So you take cash, you take bank, you take receivables, etc., and you divide it by the current liabilities. Again, higher the better. Or you have the cash ratio, where you just take the cash and short-term marketable investments and you divide by the current liability. This is the most stringent. Now, mostly people look at current ratio or quick ratio. All of these ratios, higher the better. Then there's a defensive interval ratio, which means you are taking how many days that you have to survive if you get no further cash. Let's say you have 100 rupees worth of cash and your average daily expenses are 5 rupees, which means 100 divided by 5, that will be 20 days you will have, for example, of operations, even if you get no other cash. So that is your defensive interval ratio. Then you have certain solvency ratios. As solvency ratios will be long term. So you have debt divided by equity, the most common thing, debt divided by assets, etc. Now, debt over here will be the long term as well as short term debt, that is your total debt. Sometimes people say you should take the net debt, that is total debt minus cash, that is equal to net debt. If nothing is given in your CFA exam, you will take the total debt. If net debt is required, it will be separately told and you will do that accordingly. So debt to assets is total debt divided by assets, debt to capital, total debt divided by total equity and capital employed. debt to equity, this is the most common ratio. Then there's a financial leverage ratio. This is more like a multiplier, that is your total assets upon total equity, and these are ratios. Now these are solvency ratios based on balance sheet. There can also be solvency ratios based on P&L, that is interest coverage ratio, where you will take, for example, EBIT upon interest payments, or debt service coverage ratio, or fixed charge coverage ratio. So EBIT plus lease payments upon, let us say, how much. So if I have EBIT of 100 rupees and my interest commitments are 20, that means I have 5 times coverage of my interest commitments, or interest plus lease commitments, as the case may be. Okay, profitability ratios can be linked to margin, that is return on sales. This is GP margin, GP by sales, EBIT by sales, PBT by sales, PAT by sales, or they are very important, which is return on investment, which is ROE, return on equity. Almost every investor, the core ratio that they want to study intensely is the return on equity ratio, and return on equity is the profit available to the equity shareholders divided by the average shareholder funds, which will include the share capital and reserves. So you look at ROE, that is net income divided by average equity. Return on total capital, well, total capital is contributed by debt and equity both, and hence EBIT upon the average of total debt. Return on assets, this is your net income upon average total assets. Return on common equity will be only equity, that is net income minus preference dividend upon only the common equity. Now among these ratios, the most important ratio will be the return on equity, for which they do a little more detailed analysis called as the DuPont analysis. And in the DuPont analysis, we will try to look at the break up of the ROE into 3 of its major components, and in an extended version 5 of its major components, to figure out what is the best. So over here you are trying to figure out ROE. Now ROE is increasing, but why is it increasing? Well, the analysis of ROE, when you look at the return on equity, for example, if I have this working done somewhere, okay, my return on equity is PAT divided by average total equity. What I'll do is I'll multiply and divide on both sides by sales, on the right hand side by sales. This is PAT by sales upon sales by total equity. Acha, then I'll multiply and divide by total assets. So this will be PAT by sales, that is your NP margin, sales by total assets, that is your total asset turnover, and your, for example, total assets by total equity. So this is your financial leverage or your multiplier. Now if I want to break down and figure out why my ROE is changing, my sustainable reasons for changes in ROE can be an increase in NP margin, which can arise if I were to decrease my cost or increase my selling price, which is sustainable, or a total asset turnover improvement, like for example I use more technology and that way I increase my total asset turnover. So these are operating parameters, and if there's an improvement in ROE because either your net profit margin or your total asset turnover is improving, then that is sustainable. However, if it is because you're taking more and more leverage, that is you're taking more and more debt at 10-11%, now things are going well, you're earning 12 and 13%. However, if things go bad, you still have to pay interest, and hence if your ROE increase is funded largely by an increase in financial leverage, that is not a favorable thing. So this is your general 3-step DuPont. ROE is a function of net profit margin into your total asset turnover into, for example, your financial multiplier. However, additionally, you can break this up further into an extended 5-step DuPont, where you can multiply and divide, for example, with EBIT and then with EBT, in which case this remains the same, revenue by total asset by equity, there's no change over here. However, here you have net income by EBT, EBT by EBIT, and EBIT by revenue. So what is happening over here is, if you see this further, you will multiply and divide, and if these numbers come, EBIT by sales is operating margin. Acha, but what is non-operating? Tax is non-operating, interest is non-operating. So you're studying that tax effect, that is tax burden and interest burden separately. EBT by EBIT is interest burden. So if EBIT is 100, EBT is, for example, 90, that means 0.9. So 10% is attributable to your interest. Net income and EBT. So if your net income is, for example, 70 and your EBT is 100, that means 70% of your EBT translated to net income. So your tax burden is 30%. So over here, when I look at the 5-step DuPont, I'll take the tax burden into the interest burden, into the operating profit margin, into the total asset turnover, into your financial leverage. So over here, this will help me analyze my ROE in a much better way. Now, certain cases you might be required to have industry specific ratios which are used in financial analysis. Like for example, if you look at cement companies or telecom companies, they will look at ratios unique to that industry. Like cement companies, they will use your total value by capacity. telecom companies may use ARPU, average revenue per user. So these are unique to that industry, and hence if you are an analyst, you have to understand the features of the industry quite well to understand which is the appropriate ratio which can be used for that industry parameter as well. Okay, in banks you have a lot of non-performing assets, capital adequacy, etc. So you need to have sector knowledge, and that sector knowledge you can use for the purpose of selected ratios which is useful for those industries. This type of ratio analysis and other techniques can be used to model and forecast earnings. Now this is a small LOS which Institute has now taken into a complete chapter. Again, it's more of a theory chapter. You don't have to do financial modeling or anything right now over here. You just have given broad steps. Though when you go to level 2 and even level 3, or practically when you do, and even those extra stuff that is here, financial modeling can be helpful. Ratios are forming a base for financial modeling, because if you can somehow predict the sales, then you can look at net profit margin, operating margin, and find the profits. You can look at turnover ratios. Once you can predict the sales in a top-down approach, you can look at the turnover ratios and say that if the sales are increasing and fixed asset turnover ratio remains the same, or working capital turnover ratio remains the same, then you can predict the fixed assets. You can predict the working capital. Financial modeling means forecasting the balance sheet, forecasting the profit and loss, and thereby forecasting the cash flow. For that, you'll have to forecast income statement items for which you might need, for example, margin ratios. You need to forecast balance sheet items for which you might need the turnover ratios, and hence ratios form a very good bridge to forecast the income statement as well as balance sheet items based on the growth which is there in sales. And post that, we are finally into the last leg of this FSA. It has been a good, I think, hopefully fruitful for you 2.5 odd hours, and this entire big 12 readings we've tried to kind of compress and give you the best kind of in this 2.5 hours. Hopefully you score really well. Okay, so when I look at financial modeling, it is kind of a relatively new reading that has been added, where they've just given you an introduction to financial modeling. So the steps over here will be in a top-down approach. The first thing you will do is you will try to predict the sales and future expected revenue. Almost everything stems up from that. You can do that sales prediction by doing company specific bottom-up analysis or a macroeconomy specific top-down analysis, which will study in equity. But sales forecasting remains the crux of your ability to model or forecast anything meaningful. So you'll try to forecast sales. Once you forecast sales, then you try to forecast various operating expenses like COGS, selling expenses, finance costs. For that, you look at various ratios, your understanding on whether those ratios will change or not, and thereby you'll come to profit, income tax payable, etc. So all of these are trying to forecast the P&L items. After that, you will forecast the balance sheet items. So for balance sheet items, you will try to forecast the fixed assets, the working capital, that will help you in figuring out the cash requirements. Usually, you will use the turnover ratios for this. You will try to forecast the balance sheet items using the income statement estimates. Take historical depreciation and capex. Like in steady state companies, whatever is your capex will be almost similar to depreciation. So if your company is steady state, whatever is wearing out, you're replacing. Whatever is wearing out, you're replacing. You prepare a pro forma income statement and balance sheet, and then you construct the cash flow. So your steps over here will be to forecast sales using either a top down or a bottom up approach. After you forecast sales, you kind of try to look at the COGS, other expenses, come to the profit. Once you do that, you go on into the balance sheet, you look at the sales growth. If you want to grow sales, then you need more assets. Based on the turnover ratios, come up into the balance sheet and try to forecast the balance sheet items. And once you have all of that, then like a balance sheet and profit and loss pro forma that is expected is given. From that, you can prepare a cash flow statement, and based on the cash, you can forecast and take, let's say, valuation based on present value, future cash flows, etc. There are various behavioral factors which can affect analysis, like for example, overconfidence bias. You might say that you are a topper, you can predict anything. No one, if you see in stock market, can predict everything with full accuracy. So there can be over confidence bias. There can be illusion of control. So you might believe that as a management or as an analyst, you can control various things, which as a matter of fact, even the management may find it difficult in the larger scheme. So there is an illusion that you have control. Conservatism or anchoring bias, that is, if you have given a buy rating taking certain estimates, you will not usually flip and do some other thing. You are anchored to that, and you will make certain small adjustments rather than making big adjustments. So this is, let us say, an anchoring bias. Representativeness bias, that is, whatever is the representative data sample, you will usually try to take based on what is easily available. And confirmation bias, which means if there is a particular thing in your mind, you try to get the data, try to make forecast which confirm with your assessment. So these are various behavioral biases which might be there in your forecasting exercise. Then you have to look at the competitive positioning of the company. Now this is entirely done in the equity section. In fact, forecasting is an equity exercise, not a financial statement domain, at least over here. So when I look at the Porter's 5 principles, you look at various things which can affect, like when you're predicting sales, you figure out what is the type of industry in which you're operating. Do they have a lot of threat of substitutes? Do they have a lot of strong industry rivalry? Does the buyers or the suppliers have strong bargaining power? If all of this is happening, then you have a fairly weak position. Like if there is a lot of substitutes, then you have less pricing power. If there is a lot of rivalry, again you have less pricing power. If your pressure on input cost is higher, that is suppliers have good bargaining power, then again you will have lesser pricing power. So over here, if the threat of new entrants is quite high, then you again have lesser pricing power. If the threat of new entrants is low, you have lower pricing power. So all of this will be done in Porter's 5 principles, and you have tried to figure out that your ability to predict the sales growth or sales price increase, you should look at, let us say, Porter's 5 principles and figure out how well you are placed vis-a-vis the Porter's 5 principles. Further, when you go to the cost level, there can be a lot of inflation. Now, when you look at inflation, are you able to pass on that inflation to the buyers? If you are, will your demand change? That is how elastic your products are. So all of this has to be seen. Like over here, input cost will increase. Will you be able to pass on that increase in input cost? How much will that impact the demand? Will be based on elasticity. So there's a lot of factors over here. They've just given you a few theory pointers which you can use, but there's a lot of factors which goes behind, let us say, this forecasting exercise. Considerations for choosing explicit forecast horizon. Well, I don't know. Maybe forecast horizon should be something maybe 3 years, 5 years, depending on, you can reasonably forecast. So over here, if I am an analyst who is looking at investing in the company for, let's say, a 5-year period, then I will try to make an effort to find the forecast during the 5-year periods, and after that I'll find the terminal value. That terminal value can be calculated using a multiple, or can be calculated using a discounted cash flow. However, you will usually try to forecast use for your holding period. However, if your holding period is long and you cannot reliably forecast, then you can forecast to the extent it is possible. After that, you will try to calculate a terminal value, which we will study in, let us say, equity. For cyclical companies which are in the business which is up cycle, down cycle, then typically your forecast should be based on the mid cycle, not be based on boom, not be based on bust. It should be based on the mid cycle data, which is usually normalized. If there are major mergers, restructurings, then your forecast should at least cover the period over which this merger acquisition events become normal. I mean, you will not just take it. Okay, so over here we are saying that they may be temporary, but the forecast period should be long enough where the perceived benefits, you might be saying that I'll get synergies, but synergies after 3 years, 4 years. So maybe you have taken the cost of acquisition now, but at least you should be considering the benefits due to synergies, etc. So your forecasting period should be at least as long to cover that. Earning projections beyond short term are lightly difficult, so you will take the historical average growth rate, maybe of the industry, maybe of your company. You can find the terminal value using a price multiple or discounted cash flow, etc. So this is more like an equity working, and largely that takes care finally of your financial statement analysis. This is something which is, I would say, very important reading, and we've tried to cover as much as possible in as much depth as possible. So this really helps you in understanding. If you have liked this, please like the video and even comment that, and that means a lot to us. So keep studying well, keep pushing your limits, and I'm sure you're going to do well. Wish you all the very best. God bless you all, and keep smiling. Bye bye and take care.